morning, everyone. Good morning. Request all of you to keep your mobiles in silent mode, please. Please maintain discipline and silence. Good morning, all. Welcome everyone to the day 2 of the sub-regional conference organized by SARCF-ICI, hosted by Hyderabad, Karimnagar, and Warangal branches of SARCF-ICI. I welcome Chairman of Hyderabad branch, CA Macharam Minvalli, to come on the dais, please. I request Chairman to accompany today's chief guest speaker, our Guru, Vijay Kumar sir, to dais, please. Thank you, sir. I request Chairman of Hyderabad branch to give overview of the today's program, please.
Thank you, Satish. You're all very good morning. First and foremost, I would like to thank a great teacher, Guru, and role model for many of chartered accountants, none other than Sri M.P. Vijay Kumar sir. Thank you so much for accepting our invitation from Telangana state branches and joining here to share your expertise and knowledge. Coming to day 2 schedule. For scheduled technical session, new schedule 3 disclosure requirements under Companies Act 2013 by Sri M.P. Vijay Kumar sir. And second session is also on Paro and a new concept called virtual CFO. Requested MPV sir to speak on the virtual concept of CFO also. And post lunch, we're having a new concept like startup registration, incentives, professional opportunities in case of the startups. Nayan Sabu from Hyderabad is going to speak on the topic. And fourth one, export and imports, intricacies under the FEMA. C.A. Murali Krishna Gottipati from Hyderabad is going to speak on the topic. These are 4 technical sessions today. First 2 technical sessions, that is 10 to 1:15. MPV sir is going to take it. Sir, again, it's a great pleasure and a proud feeling for me as the chairman of Hyderabad branch, sharing a dais with you. And friends, I'm a student of MPV sir. Not only am, many of you are sitting at students. Great honor and proud privilege to have such a man of virtue, man of simplicity, not now, from there itself. One render question of Dira, Pujama chairs, heartful matter. So beautiful, lovely on the relation. It is a relation from last 20 years, sir. Thank you so much. Sir is having army entire South India, not only entire South India, is having army across the country. And presentations not only in India, international కూడా చాలా presentations చేశారు. అలాంటి గురుని ఈ రోజు మన హైదరాబాద్ లో ఇక్కడ మాట్లాడడానికి వచ్చినందుకు థాంక్యూ సో మచ్ సార్. అండ్ సింపుల్ యూ కెన్ సే మనం అందరం చదువుకుంటున్నాం కదా, టైం వాల్యూ మళ్ళీ ప్రెజెంట్ వాల్యూ. వాట్ ఇస్ ద ప్రెజెంట్ వాల్యూ? MPV, master of present value of future ICI. Is the future for an ICI, and why I'm telling you, I'm into the committee for the last 3 years, and before that also I'm regularly following up MPV sir. MPV sir is instrumental for many policy making in ICI, and we are seeing today digital learning hub simply sitting in the house, and we are taking a lot of materials, reading a lot of books from an ICI, and simply with a click or a login. All these efforts by MPV sir, thank you sir. We are extremely proud of you having a personality like you in a committee, and is a role model and inspiration for our entire fraternity. And again, sir, really blessed to share a dais with you. Thank you so much for joining here. Thank you all. Thanks for joining here.
Thank you, Chairman. We are going to start our first technical session of the day 2. I request CA ACS Reddy, Sikasa Chairman, Hyderabad branch to give a health bouquet to today's speaker. Thank you, ACS Garu. Chairman sir, again I'm giving you what is the favor or trouble. Request you to introduce today's speaker, CA MPV sir, please.
Sir, నేను చెప్పింది మీ ఇంట్రడక్షన్ ఎవరికి అవసరం లేదు, but it's for me. It's a great chance for me, great opportunity for me to introduce you, sir. Friends, it's again a great pleasure and proud moment for me to introduce the legendary personality of an ICI, Sri MP Kumar sir, MP Vijay Kumar sir. Where to start, how to start is a big book, like in our accounting standards and the IFRS. Very brief, I'll tell you about MP sir. For 27 years of experience in industry as a chartered accountant in practice, and sir is a Central Council member of Institute of Chartered Accountants of India from 2016 to 22. He is a chairman 1921 Accounting Standards Board, 1819 Valuation Standard Board. Sir is a chairman Digital Accounting and Assurance Board for 1918. Sir is a vice chairman for 1921 for Expert Advisory Committee, and 1819 Financial Review Reporting Board is a vice chairman. And again, Committee on Accounting Standards for Local Bodies, sir is the Vice Chairman for 1718. Sir is a nominee member of SAFA Committee on Accounting Standards Board, National Financial Reporting Authority, ex officio, Quality Review Board, and SEBI Committee on Disclosures and Accounting Standards. And is a present member of Auditing and Assurance Standards, Board of Studies, Corporate Laws and Corporate Governance Committee, Ethical Standards Board, Internal Standards Board, Internal Affairs Committee, Research Committee, Management Committee, Executive Committee. Is a present member of an ICA on all the standing and non-standing committees. Sir is a member of IFRS Advisory Council for the year 1921 and member of SMGIC. Sir is having a rich experience and presently sir is the CFO of CP from 2007 onwards, and previously 1999 to 2007 the partner in Jagannath and Ram LLP. And 90 to 99, sir is head investment banking and company secretary for Sundaram Finance. Sir is presently director in XP Oral India Limited, CP Singapore PTA Limited, and Celo India Software Services Limited, former director of National Internet Exchange of India Limited. Sir is a resource person, we all know. Sir has taken seminars and presented papers across the India, not only India, internationally also. Sir presented papers. Having a 20 years of a teaching experience of accounting, financial reporting, and corporate law. And sir is present an associate of Confederation of Indian Industry and Board of Governors, Madras Chapter, life fellow member of Institute of Directors, member of Board of Studies of ICT Academy, member of Regional Council. Lot of award winner, lot of awards, and he got an award from Capital Foundation Society, National Award for contribution to financial accounting, and CFO top 100 roll of honor. Not only that, sir is also author. We all know. Me book chaduvuntu pass ayyanu sir. ICDS, India's Audit and Assurance Standards of India, Corporate Law, Advanced Accounting, Auditing Standards, Auditing Standards. A lot of books. Sir, only I am taking few books. Again and again I'm telling, sir is the present value of future ICA. And thank you, sir. Thanks for being here. And this is only brief. We are having this much of size of profile of this, sir. But take up time reading only one paper. Thank you, sir. Thanks for joining.
Thank you, Chairman Garu, for a big personality and gave a small introduction actually. Thank you very much. Now I'm requesting MPV sir to take forward the session, please.
We have recorded.
Yes, sir. Yeah, Glenn.
No, I thought it was largely students, so I thought I'll. Manager ಗೊತ್ತಲ್ಲ, people are. ನೀವು ನಡೆಸ್ಬಿಟ್ರಾ?
Sorry, change this. Wait, sir. We will-
Okay, while they do it. Extremely happy to be here at Hyderabad this fine morning. And I was actually a little surprised when the event date was 30th of December. I was not sure whether there was a typo or 30th January becoming 30th December and all. But then if it has been conceived at Hyderabad, I thought they would have taken all aspects and then finalized this event. I think it's providence that I get the opportunity of interacting with a large number of students after a very long time, very long time. In fact, as Machar mentioned, my career has been largely around teaching. And in fact, one of the reasons I accepted, despite the fact that it was a quarter end for me also, I'm also CFO of a US SEC listed company, was because for me, people like Machar, who are all students, I owe whatever I am today because of their success. So whether he, Reddy, Siva, all of them happen to be my students. Because they succeeded and did well in life, people thought I contributed to that, which is within quotes true or untrue, God knows. But I had the opportunity of being part of their journey. And when they invite, I feel so very obliged that I should positively be here. And that's how I accepted the invite and I'm here today. I know most of you must be doing articles as well, and I'm thankful to your principals for having given your time to be present here, because I know all the officers must be going through very tough time schedule these last 3-4 days. It's not an easy one. We have been in articles, I've been in practice. I don't know what these deadlines actually mean. So greetings to Chairman of the branch, first person of the branch, Machar, managing committee members, other members of the profession, and to the future of the institute. So as far as today's session is concerned, we have three topics. One is Schedule 3 revised, which is applicable for current financial year 21-22 onwards. The second topic is CARO 2020, which has been deferred and is also applicable from current financial year 21-22 onwards. And last is a little different topic where I'll speak largely from my experience, which is a topic around this big buzz called virtual CFO. So what I will do is between now and the break, probably around 11:45 or so, I'll spend time on Schedule 3 revised and CARO together. I'll bundle it up. And there's a reason why I'm bundling it up. I'm bundling it up not because it is convenient to me. I'm bundling because both of these have been conceived by the Ministry of Corporate Affairs as a single reform, except that they have come as two separate documents. In fact, particularly members here, and several of you might also be aware, CARO 2020 was supposed to be applicable for the last financial year itself. Financial year ended March 21, that is financial year 2021, but it was postponed by a year. Not because of the pandemic, not because of the pandemic, not because the members felt it was too short a notice and they required time to understand and implement, not because of those reasons. The reason why it was deferred was because CARO 2020 places responsibility on the auditor to express an opinion on so many number of items, which number of items are being expanded significantly. And if an auditor has to express an opinion, he can express an opinion on what the preparer has given. So if a preparer is not giving information, I can't give an opinion on that. So I can give an opinion only if the preparer is making available the information. So preparer of financial statements, they give information in the financial statements, which is Schedule 3. So it was important that Schedule 3 amendment should also be completed by the ministry so that preparers can give information in financial statement and auditor can express opinion on CARO, So Schedule 3 and CARO are amendments which have to be read only together. So Schedule 3 amendments which came 24th of March 2021 has to be read only with the CARO 2020 which has already been issued. Now, little bit of context setting for all of you, and considering that you're all the future of the profession, young people, it's important to understand conceptually a few things very well, so that whenever there is a requirement, you can understand why that requirement exists. So all of you are aware that businesses, more specifically corporates and LLPs also, which is another form of business organization, limited liability partnerships, are governed by one arm of the government called the Ministry of Corporate Affairs. As far as the Ministry of Corporate Affairs is concerned, many of you do visit the site of MCA, but it's important that you understand their mission, their purpose of existence, so that you can understand their actions, why they are acting in a particular manner. You should understand why somebody is behaving in a particular manner. So if you look at the Ministry of Corporate Affairs, it may not be visible to all of you at the back, but let me read for the benefit of all of you. Ministry of Corporate Affairs has set upon itself four objectives. And anything the ministry does, they do it only in the context of these four elements. One, their interest is to be an effective regulator. That is one expectation. Second is they would like to be an effective educator. They want to do the activity of educating the stakeholders at large. They want to enable that as well. And for that, apart from Institute of Chartered Accountants, Cost Accountants, and Company Secretaries, there is also one more arm of the ministry called Indian Institute of Corporate Affairs, IICA, through which the ministry actually disseminates knowledge. It wants people to think in a particular manner. The third of the roles is to act as an effective integrator, so that you don't function in silos. A business organization is part of society. A business organization is part of society. Just like you and I, individuals are part of society. A business entity, whether it is a company or an LLP, is also part of society. So whatever actions a company does should be integrated with all of the society's requirements. I'll give you two examples in that context, and all of these will be extremely helpful. when you start preparing later for your interviews, etc., because these are all conversations you will surely come across. So as far as the businesses are concerned, as I just told you, they are part and parcel of society. And it is important that just like you and I are responsible citizens, businesses should also function in a responsible manner. And from the government, from the Ministry of Corporate Affairs, we have what is called National Voluntary Guidelines for Responsible Business Conduct. National Voluntary Guidelines for Responsible Business Conduct, where the ministry has laid down what the 9 principles. They have laid down 9 principles on how businesses should function as an integral part of society. And around this, I'm sure most of you would have been hearing buzzwords called ESG. Buzzword called ESG. So environment. All of you in the back as well. ESG you have heard. So environment, society, social and governance. ESG. And over the next few years, if there is some term which will be excessively used, it is this term called ESG. You'll find it all over the place. You'll find that word all over the place. Next 3-4 years, you turn a page and you'll find only this term called ESG and a terminology called triple bottom line as to how much you are contributing to the profit, how much you are contributing to the people, how much you are contributing to the planet, that is the earth in general. So you are measured not just by how much profit you make, but also by how much you are contributing to people development, how much you are contributing to the planet. So that is what we call as triple bottom line. So these are all terminologies or concepts which are at early stage, but these concepts are going to be pushed so hard, and the pace of its adoption will be at such high pace that you and I can't even imagine the pace at which these changes will happen, because there is a huge realization among the society and across the world that businesses have to function in a very responsible manner. And around that, we have what is called sustainability reporting. And for the top 1,000 listed companies, current year voluntary, next year mandatory, we have what is called business responsibility and sustainability reporting requirements. So lots of things are happening. And just to give you one more point around the pace at which activities are happening on this. And I've been saying this for quite some time. When it comes to your generation, I will not be surprised, and I'm witnessing it. I'm not surprised, and I'm witnessing it. Your generation will not work for organizations which don't have good ESG policies. Your generation will not buy products which are not ESG compliant or environment friendly, and your generation will not supply products to organizations which are not ESG friendly. And these are not statements which I'm making out of the blue. These are reality which I am seeing on the ground, and I'll give you 2-3 small examples. Example 1, I'm sure most of you here can connect it so very easily. Almost all the young minds who are sitting here, when you're looking at either your first vehicle purchase or replacing your existing vehicle, I am seeing the current generation looking at buying only a EV, only an electric vehicle. They are not interested in a fossil fuel vehicle, despite the challenges of the distance you can travel, the speed at which you can travel, and the uncertainty around recharging. The young generation is also prepared to pay a premium, pay 20,000-30,000 more, but get an environment-friendly product. If businesses don't see that reality, if organizations don't see that reality, they will become a Nokia, they will become a Kodak, they will cease to exist. The hard reality is there is this big young generation who will not do anything which is not environment friendly. They will just refuse to do it. Just like very simple things like a printout. At my age, I feel so very comfortable every time I tell, give me a printout, I want to read. The current generation, thanks to the schooling over a period of time, and I should give credit to the schools and the teachers in the school, they have planted it so strong in the children. The tree cutting environment, they've planted it so strong in the children that children hesitate to take printouts. They just don't take printouts. They would just like to do work only on electronic board. So that's the kind of change. And MCA has taken upon the responsibility of being an integrator. Integrator where the business organization has to integrate with the society. And fourth objective of MCA, and I'm quoting all these from their website. The fourth objective is facilitator, to facilitate business growth and ease of business. So anything and everything which MCA does, while the initial reaction of people would be that, oh my God, one more requirement, one more compliance. But every action of this, if you can see through their eyes, then you start appreciating those changes. And once you understand why a change has happened, you'll voluntarily comply with those changes. So all of you, your life will be integrated so closely with Ministry of Corporate Affairs. So all of you tomorrow, when you become chartered accountants and become professionals, whether industry or practice, you'll all be so connected to the Ministry of Corporate Affairs that it's important you should know the purpose, the mission of the Ministry of Corporate Affairs. Now, this is a standard caveat, and so whatever I speak over the next 1.5 hours, all of it are my views as a professional. None of them should be seen as views of any of the committees of the institute or of the council of the institute. Now, as far as the financial statements are concerned, or audit opinion on financial statements are concerned, it is very important to recognize the following, that financial statements is a communication. Your balance sheet is a communication. Your P&L is a communication. Notes to accounts is a communication. Audit opinion is also a communication. Just like you and I in personal life, you and I want communication which we receive, whether it is from colleagues, whether it's from team members working with us, or from the clients, or from family members and friends. All of us want any communication we receive, we want that communication to be truthful, and we want that communication to be complete. So just like you and I have that expectation, the user of financial statement, the user of an audit opinion also has exactly the same expectation. So the user of financial statement, whether it is an investor, lenders, or any other stakeholders who are using, they are expecting from you and me. They are expecting from you and me, whether we are a preparer or an opinion maker, audit opinion, they are expecting that our communication has to be A, truthful, and B, it has to be complete. And if you can work every day during your articleship or in your professional life professional life, if you can work keeping in mind that the product which you do prepare, the product which you do, when financial statement audit opinion is not meant for you, it is meant for somebody else, and for that somebody else, truthfulness and completeness are important. Then the quality of work which you do itself will be significantly different. So with this little, Chingal, welcome Chingal. Now, before I get to the core of the topic, and I'm aware that some of the members are participating through the video. I just want to share for them, benefit of them, that given the fact that it is the tax filing last dates and all, we have mix of participants here, a reasonably large number of students and members. So with due permission of members, I'm orienting my talk largely towards the students and trying to be little more basic. So kindly excuse me if I'm not speaking at an issue level or a very high level. I'm trying to use this opportunity, given the mix or the profile of participants here, and take it in a little more simplistic manner. Hopefully, I'll get some other opportunity to back at Hyderabad branch, at which time I'll spend more time on practical issues around this. So with this little bit of caveat, let me come back here. Founder President of the Institute, late Shri G.P. Kapadia, and a gentleman about whom I had the opportunity of learning more only from 2016, and I regret why I did not learn more about him earlier. Way back 1949 onwards, I had the opportunity of reading his various speeches. I read it around 2016-17 when I went to the council, and the quality of his thinking and articulation, that seeds which he has sown is what this profession is today. And here I am presenting to you a couple of very important lines from several of his speeches. I will not read the whole paragraph or quote the whole paragraph, but just let me bring a couple of lines. And I want you all to connect your day-to-day work. Whether you are doing an income tax filing or a GST filing or an audit opinion, I want you to connect it with his thinking. He says that every learned profession should have a sense of social purpose and social obligation. And it is more so in the case of accounting profession. And when he talks about social purpose, social obligation, it does not mean, mark my words carefully, it does not mean planting trees and doing whatever donations. That is not what he means by social purpose, social obligation. What he means is the professional work which you do, you should be conscious of the impact it has on the society. Conscious of impact on society. Let's take a very simple example, and I want you all to get this fundamentals very strong. Impact on society. Many of you might be aware, we have this law called Insolvency and Bankruptcy Code. The experience over the last 4 years since the code has been implemented is most organizations balance sheet on 31st March 2019, signed in August on going concern basis, and 2 months later, October 2018, 2 months later, the company has filed for insolvency. So balance sheet signed in August 2019 for 31st March 19, saying the company is going concern, which means the person is signed with his eyes wide open that the company will survive for at least another 12 months, and hardly 2 months later, the company has gone for insolvency. This is the case with 99.99 recurring of cases which have been filed with insolvency registration. Now, the other experience on insolvency is, insolvency basically means assets are not sufficient to pay the liabilities. And these liabilities are largely loans given from banks and financial institutions. So the experience is, when these insolvency are either resolved or going to liquidation, the assets have hardly been able to meet 30% of the liabilities. Hardly been able to meet 30% of liabilities, which means banks and financial institutions had to take a haircut of 70% of the loans. Imagine loan of 100 crore, 1000 crore, 10,000 crores, 50,000 crores, 70% of loan is being written off, and that loan is a bad debt in the books of the bank. So in the books of bank, who bears the loss? Who is bearing the loss in the books of the bank? Is it employees of the bank who are bearing the bad debt? Is it the shareholders of the company who are bearing the bad debt? The answer is, it is borne by the public at large whose deposits are there. So typically in a bank, the capital adequacy ratio deposits are the substantial source of funding. So what happens is, if banks are lending at the rate of 9%, they keep 1% for profit, 2% for overheads, another 1.5% for bad debts, and pay you and me the balance interest of 4.5%. Inflation is 7-8%. Inflation is 7-8%, but you and I earn 4.5%, which means our principal is getting eaten away. And that is social obligation. So if that bad debts can be minimized, if our financial statements preparation, if our audit opinion can raise enough red flags, and reduce instances like this, that is the huge contribution to the society. So this gentleman talks about accounting profession being socially responsible in that particular context. This tree plantation, etc., is personal social activity. It is not an institution social activity. Sometimes I get a little confused on these things, but the social responsibility is that. And he goes on to say that when a chartered accountant gives a certificate, the society tends to rely on it very, very strongly. Now, so with this backdrop, let me come to the next. So these Schedule 3 amendments which are there, as you saw in the opening slide, these amendments have got notified on 24th of March 2021 and applicable from April 21 onwards, financial year beginning April 21. And from the institute, we always have a guidance note on Schedule 3. The guidance note has been prepared, exposure draft already given, comments have been received. The guidance note will most likely be published by mid of January. So year ending is March 22. So by mid of January or maybe third week of January, the guidance note on revised Schedule 3 will come. Schedule 3 has 3 divisions. One of it is for companies to follow the accounting standards framework. Companies Accounting Standard Rules 2006, which are now replaced through what we call a mirroring project with Companies Accounting Standard Rules 2021. Then Division 2 for companies who follow the Ind AS rules, Ind AS framework. Companies Ind AS Rules 2015, which is the IFRS framework. That is the second framework. And then for non-banking finance companies, we have another division. So there are three divisions. All the three divisions have undergone some amendments. But please note, of the amendments, 95% is common across all, 97% is common across all the three divisions. There's some incremental amendments for Division 2 and Division 3, very, very small incremental amendments. And for most of you, what you should be more concerned about is Division 1. Now, as I told you, applicability is from April 21. Now, at the start, I mentioned to you that CARO and Schedule 3 amendments, both of them are an integrated project. Both of them are an integrated project. And integrated reminds me, and maybe I'll step back. I want to highlight one very important point for benefit of all of you. Around ESG, I want to highlight one more important point. I talked about employees, customers, vendors, but something more important I want to highlight. Going forward, and it's already happening now. I don't think I should tell you going forward. I have seen deal sheets, I have seen term sheets where private equity, venture capitalists invest only in companies which have good ESG practices. Otherwise, capital is not available. It is not available. The reason is private equity people are basically people who have raised money from billionaires across the world. So private equity is nothing but very rich people contributing to funds managed by Blackstone, managed by Brookfield. They're all funds. But these funds have come from super rich guys. And those guys are keen that their money should go towards improving the cause of the planet. So when they give money to private equity funds, they tell you can invest this money only in companies which have good ESG practices. The same is happening on the lending side also. Currently, banks have set apart separate portfolio of funds for lending to companies who are following sustainable practices. And over a period of time, they will not lend to companies who don't have good sustainable practices. And I don't know how many of you would have noticed yesterday, and I think it is IndusInd Bank. I don't remember the name of the bank correctly. I think it's IndusInd Bank. Yesterday, they have said that the deposits they accept, savings bank deposits, people like you and me, SB accounts, there are fixed deposits. They said, we will raise separate fixed deposits which are green deposits. So which means as an individual, when I give a fixed deposit to bank or savings bank account to bank, I tell that this money, you can use it only for lending onwards to companies who have good ESG practices. So one of the banks has done it yesterday. So I'm highlighting all this just to tell you, ESG is not a buzzword somewhere just to hear. The pace at which it will get implemented and adopted is something which I would have not experienced in the past, but that kind of an experience you will see over the next few years. So getting back here. As far as the CARO 2020 is concerned, this amendment has a little bit of a history. CARO is an additional reporting beyond the audit report, beyond the templatized audit report, where you give true and fair view. And CARO reporting is something fairly unique to India, You don't find it in other jurisdictions. It has its journey beginning from 1975 and it has gone through several avatars. It got revised multiple times. And when Companies Act 2013 came into existence and this new government came, they came with a very powerful slogan called, less government and more governance. Less government and more governance. And they also took upon a mission of ease of doing business. They wanted to make business running pretty easy. So under the new Companies Act, when Caro was brought in under the new act, the earlier Caro was collapsed. The earlier Caro was Caro 2003, which was a big document. They collapsed it and made it as a short document. So 2015, this revised Caro came in. And within 5 years, the government's experience was this abridged version was not helping the cause of the government overall supervision and ensuring good governance practices. So given the experience of the government, and I've seen when this document was being drafted, the regional directors of MCA and the ROCs of MCA, they were very furious. You can actually see them spitting fire, saying that there is so much of misgovernance happening. Company structures are being misused so badly, and there are evidences plenty. And given that kind of feverish approach of all the regional directors and the ROCs, this new Caro had to come into existence. And whatever new Caro which you see now is almost 2.5 times the existing Caro, but the original proposal was to make it 4 times. But after a lot of pulls and pressures, it eventually settled there. And this particular revised Caro 2020, and please note, it is not the final. It's not the final. If the governance standards don't improve, I will not be surprised if within 3 years, the 21, that is 47 subclauses become 74. I will not be surprised. Because government believes that there is so much to do on improving governance. Now, all of us as accounting professionals often keep hearing about the expression called expectation gap. And when you say expectation gap, as audit fraternity members, not as students, as members, many times we take a path saying that I've done what I could do, and if gaps are there, it is you are expecting something more. So we always try to say that I did what best I was required to do. If you expect something more, what can I do? So that is the path we have taken, and that is what is called expectation gap. So what MCA is trying to do through this is clearly spell out now, this is our expectation. You tell me now, this is our expectation. Report, so that you don't complain tomorrow that we expected something more. So they have walked this extra step of telling that this is the expectation from all of us. My view from that sense, it is a very welcome development. It's a very welcome development. And for the members who are attending here and on online mode, Caro 2020 reporting will be a nightmare. It's not going to be like the earlier Caro of a checkbox approach. Here, Caro 2020, the way questions are being framed and the way you are required to give answers, is pretty onerous, and unless someone is performing the audit with very high level of independence and objectivity, you cannot do a professionally correct job in CARO 2020. It's a fairly exhaustive requirement, and main reason of CARO 2020 is to bridge the expectation gap, where MCA said, here is my expectation. Now you guys respond to my expectation in reporting here. Now, as far as the CARO 2020 is concerned, as I mentioned to you, it replaces the earlier CARO, where some clauses have been deleted, some clauses which were not found relevant, not useful, have been deleted. Some clauses have been retained as it is, no change. Some clauses have been amended. They are retained, but they are modified. Some clauses which were there in the earlier 2003 CARO, which was an earlier 2003 CARO, which was deleted in 2015, they have brought it back. And some clauses have been added. So as far as CARO 2020, which is applicable from 21-22 is concerned, so it is a completely fresh document. It's a fresh document. Effectively, only 7 clauses have been retained as is. Others are either modified or fresh introduction or brought back. And that's the list of 47 sub-clauses which are there. It's actually 21 questions, but within 21 questions, there are sub-questions. Each questions are fairly independent. So for all practical purpose, it is like 47 questions you have to answer. 47 sub-clauses, 47 questions to be answered. Now, for the members in practice who are here and online, as far as CARO 2020 is concerned, my sincere submission to all, having had the opportunity to work closely with the government, do not look at CARO 2020 as an additional responsibility. It is actually a powerful tool. It's a very powerful tool given in your hands for communicating the work which you have done, and to raise the necessary red flags for the government to act upon, particularly around related party transactions, diversion of funds, etc. So instead of regulators feeling that you did not tell me, here is a questionnaire which says you are required to inform, so that regulator can take necessary action. And I also want to say 2 things. One, and I would request the branch managing committee and all, every opportunity you get, every program, when the 21-22 financial statements are filed with MCA, next July, August, September, whenever you file, MCA has developed an IT tool with AI capabilities, where whatever documents you file, that IT tool will scan it, identify non-compliances, and notices will get issued. So if someone felt that, okay, we'll just file it and life will move on as in the past, the answer is no. Government is extremely clear that they want to improve the standards of governance. Despite whatever challenges we might have societally, they are very determined that the standards of governance have to be improved, and for this they are investing in those tools. So CARO 2020 is not going to be like earlier ones. We'll just file another document. It's not going to be like that. The second point I'd like to mention, particularly for members in practice and also probably the senior guys in articleship, for all the clients for whom CARO 2020 is applicable, and for that matter, even Schedule 3 revise, I would strongly advise early January for the March 21 financial statements already over. For the March 21 financial statements already over, prepare those financial statements in Schedule 3 revise and inform the client that this is how your financial statements will look in April, May now. Inform him now. And any case you have to do this because when you finalize accounts for March 22, you have to give previous year figures of March 21. So in any case you require that. And some of these requirements will be very painful, and some of these requirements, some entrepreneurs may not be able to digest or comply with. I'll give you small examples. Aging of receivables 90, 180, 360, 2 years, 3 years. And with that kind of aging of receivables, MCA will come straight and stop on, is revenue recognition correct? That's where the question will start. Aging of payables, that is also okay. They go one step forward. Aging of provisions. So when you do aging of provisions and all, in Companies Act, if there are unpaid dues for more than 1 year, they'll be treated as a deposit under the Companies Act. So if it is a deposit and not complied with the deposit rules, the liabilities are severe. You have understood. So on liability side, aging has to be published for both creditors and for provision for expenses as well. And those are things not easy. Same with capital work in progress. So all those requirements are there. So as I said, please, January as early as possible for the year March 21, prepare using revised Schedule 3, draft the CARO report for last year, show it to the clients and ensure the client is prepared on the same. On CARO, I'll give you one observation. One observation which many clients will suffer to comply with. One of the requirements of CARO 2020 is if you have bank borrowings of 5 crores for working capital, fund and non-fund, including LC, BG and all, 5 crores. 5 crores is tiny amount. Institute, we fought very hard to make it 500 crores, only listed companies, but it didn't work. So 5 crores, if you have, you are required to give a comment whether the stock statement filed with the bank. Stock can be physical inventory, raw material, WIP, finished goods, receivables. Are they tallying with the books of account? So for organizations who don't prepare quarterly accounts, for those who don't prepare quarterly accounts, unlisted companies we don't prepare. For those who don't prepare quarterly accounts, you will not have inventory figures in your books of WIP and finished goods because they require what we call cut-off procedures. So in this backdrop, you will invariably end up with reconciliations which you have to present, and those are not going to be easy. They're not going to be easy. So you should go back to that earlier period, quarter ended 30th June, 30th September, 31st December, and reconcile, ensure they're consistent, proper application of mind, and then you have to give your CARO 2020 report. So given this kind of huge implication, I'd strongly urge in the month of January, do a pilot project based on March 21 financial statements and get the organizations ready. You don't take the responsibility of defending the client. Let the client defend himself or herself, unless you are a preparer for the client. If you are an auditor, I would strongly urge, do not get into defending the client. It's his or her responsibility to do the same. Now, as far as the summary of changes is concerned in Caro 2020, newly added clauses. Detailed study of these clauses I am not venturing, but I'll try to explain in brief each of these things. First and foremost, transactions which have not been recorded in books. It is the experience of the ministry and all that there are many cases where they come across undisclosed income discovered through tax searches, tax processes and all. So what this clause says is, you are required to report whether there is any such undisclosed income. There are many cases as part of tax planning, income is not recognized or it is kept as advance receipts from customers, whatever, different ways are there. So all those things you are now required to report. That is one newly added clause. The second clause is on ability of company to meet liabilities in the next 12 months. So imagine, as an auditor, you have to sit on judgment and tell this client has the ability to pay the liabilities in the next 12 months, which means look at how much should be your understanding of the client business, client's ability to continue whatever activity, manufacturing or other activity, client's ability to collect the receivables, and the client's ability to make the payments. There are many businesses where, because of macro or microeconomic conditions, including supply chain issues, production has come to a halt. 3 months I am not able to produce. I'll give you a small example. Now currently electronic chips are not available, and there are many ancillary units who produce components for automobile industries and electronic goods. Those ancillary units are all 3 months production shutdown because the chips are not available. Globally. I'm sure those who are fairly looking at automobile industry, your waiting period is now 3 months, 4 months for almost all vehicles because chips are not available. And some automobile companies have gone to such an extent that they've stopped giving you a spare key because the key also has a chip. They're saying that we'll give you the spare key after 3 or 4 months. With this one key, you take delivery of the vehicle and produce. So there are many such challenges. So the auditor's ability to understand a business, its ability to continue operations, realize the receivables, and pay the liabilities. So auditor has to give a comment. And just imagine, I have signed the auditor report in August that yes, they can meet it. And if October company defaults, automatically auditor will get exposed. By October, even if it is next March, auditor will get exposed. So look at how much of understanding of business you have to have for you to give an observation of that. So, and you can't write general English that it is expected to be, all those language will not work. The way question is drafted, the answer is either an yes or a no. So this, you cannot have the luxury of drafting like what we all used to do in earlier Caro for fixed assets and physical verification. We used to write our best English talent used to come. It is generally verified, generally there. We used to find our own language to write that. All that will go away now. The answer is yes or no, which means unless you understand the business so very well and the working capital cycles, that clause you will not be able to answer. The third of the new clauses which have been added, third of the new clauses is on CSR, which is mandatory for a fairly large number of organizations. There is a requirement of spending the 2% of profit, all that stuff, 135 and all. So by end of the year, if you have not spent it, you are required to transfer it to a certain fund. But if it is for some ongoing projects, you have to keep it in a separate bank account, spend it within the next 3 years, otherwise transfer. So you are now required to make a report on whether the company has complied with the requirements of section 135. Then statutory auditor resignation. If there is an auditor change during the period, you have to give a observation that there was an auditor who resigned during the period. Reasons are so and so, and I have got the necessary transition. Whatever he had to tell me, I have received it, and I have performed an audit considering those factors as well. So you are required to mention that. Then, in consolidated financial statements, the original plan of MCA was we should have a carry for consolidated financial statements also. Imagine for a moment, I am holding company A Limited and I have 6 subsidiary companies, and these 6 subsidiary companies may be as part of succession planning. Some of them are managed by my son, some by my son, daughter. So all those things, and I consolidate it here. For the consolidated entity, a CARO report had to be published, but later MCA realized, based on active inputs from Institute, it's not possible. And instead, the reconciliation was, we agreed on one clause. So if any of the subsidiaries, the CARO has a negative clause, we have to give a para in the CARO of the parent company, and tell that subsidiary S1 clause number 18 is a negative clause. Subsidiary S2 clause number 14 is a negative clause. We need not write what is that negative clause. So you only do a cross reference and tell that for these subsidiaries, this clause as a negative or adverse observation. So that is one clause which has been added here. But friends, I want to caution all of you. It is all up to us. If you want the CARO to remain here or shrink or allow it to expand further. Some of the members here, particularly senior members and all, will know. In the context of bank audits and all, we have a long form audit report, which is a huge fill in the blank exercise which we do. The Ministry of Corporate Affairs is having a suggestion on its table that a similar long form audit report should be done for companies also. That suggestion is sitting now in their table, and it is on their table for the last 1 year. 1 year, they want something like that to come. Personally, for me, it would be extremely onerous on the profession to respond on that. Even for banks, I know how people actually do it. It's more a checkbox which people are doing, and it will be even more tougher here. Now, getting back here. The next is on internal audit system. Whether it is commensurate with the size of the company, you are required to make an observation on that. And on internal audit, one very important point is, and these are again activities which the statutory auditor has to work very closely with the internal auditor. So what it says is, during the year, whatever internal audit observations are there, whether all those observations have been addressed. If those observations have not been addressed, what is the impact on financial statements and how you have satisfied yourself. The statutory auditor has to tell that. So it's not an easy clause. It's not an easy clause. So we know how internal audits are done. Some places they are risk-based and very well done. Some places they are transaction-oriented. So where the balance lies is a different discussion. But as a statutory auditor, I should have gone through all the internal audit reports. I should interact with the management. If there are 40 observations during the year, whether all of them have been implemented, and I should satisfy myself about their implementation, and those which have not been implemented, those not implemented, I should satisfy myself on whether it has an impact on the financial statements which are prepared and give a comment on the same. So that is another clause which has been added. The other clause is on cash loss. If the entity is incurring cash losses, the details of the fact that you're making cash loss should be brought to the attention of the users. Then there are clauses which have been modified on fixed assets. There's a cosmetic change, which is property, plant, equipment is the expression change, which is rightly so. And the important changes in fixed assets are two in number. One is, have fixed assets been revalued during the year, and whether that revaluation has been done by a registered valuer, whether the accounting is correct, and the impact is more than 10%, separate disclosure, reconciliation, etc. So that is one change as far as fixed assets are concerned. The second change on fixed assets is title deeds. Title deeds. Whether the title deeds of fixed assets are with the company, and if they are not with company, in whose name? Is it in director name, relative name, this name, that name, subsidiary name, this name? Why it is in that another person's name, and when it is expected to be transferred. So for property, plant, equipment, and even for intangible assets, if they're not in your name, the reason is the insolvency experience of 2007, and I have witnessed a few. When banks go to realize the security, the banks to their shock come across a situation where the property is not even owned by the company. So property has been mortgaged, but it is not owned by the company. So those instances are plenty. To plug that, and recall I told you, purpose of CARE 2020 and all is to raise red flags. So in practice, will there be instances of property in some other person's name? Answer is yes. For example, if I am buying a real estate from Sunil, let's say on 28th March. So I paid consideration, possession is handed over to me. The registration I may complete only in May or June. So 31st March, it is my property, plant, equipment, but title is not in my name. Title as per the municipal records is only in Sunil's name. So I need to make a disclosure saying that this is the factual background and the user of financial statement understands. So this is about the second amendment. Then comes inventory. On inventory, the amendments include physical verification, discrepancies which have come across. If they are more than 10%, you have to give a specific answer on how those discrepancies are being dealt with. Repayment of loans granted by the company, whether they have been repaid on time, etc., so that the culture of repayment is there. Default in repayment of dues. Reporting of frauds. So if frauds have happened, 143, etc., whether they have been reported as per the requirements of 143 or not. Nidhi companies, its separate disclosure requirement is there. And for those NBFCs who are required to register, whether they have initiated the process of registration. So those are all clauses. They're existing clauses, but they've been modified. Then there are some clauses which have been retained. Clauses relating to acceptance of deposits from public, clauses relating to maintenance of cost records, clause relating to loans, investments, and which are there, end use of funds, application of funds, related party transactions, non-cash transactions, and lastly on payment of statutory dues. One clause has been deleted, which is the clause around managerial remuneration. The reason is managerial remuneration, any case is calculated as per the provisions of the Act, and if you are not providing as per the Act, you have a reporting obligation. Reporting obligation already exists. So because there is a duplication, this has been cut off. Doesn't mean if I pay excess managerial remuneration, there is no reporting to be done. There's reporting to be done elsewhere, not under CARO. So this is broadly the summary of CARO changes. Now, coming to the next set of changes. So as far as the clauses are concerned, okay, as I mentioned to you, there are about 47 sub-clauses. It's a fairly huge one. So please don't get carried away by 21 clauses. It's actually 47 Q&A. 47 Q&A. It's a huge responsibility. Some of them have multiple sub-clauses. Some of them have a single sub-clause. But in all, 47 sub-clauses are there to answer. Now, amendments of Schedule 3. These amendments which are there in Schedule 3, I have classified them into different categories. And please note, these are my classification. These are the changes, but the heading, the first line alone is mine. The first line alone is mine. Rest of it are as per Schedule 3. So the first line, the description tells you the nature of change, the background of change, the intent of change, and what MCA expects. First and foremost is some of these changes in Schedule 3 are basically for enhancing the disclosure requirements and thereby governance. So the idea is to enhance the way businesses are governed. So one set of amendments in Schedule 3 are all meant to achieve higher levels of disclosure and governance. One, promoter shareholding. Between last year and current year, has the promoter shareholding gone up, come down? Gone up, come down. Please note, we have a similar requirement already for listed companies. For listed companies, we already have. And this is a change which has been introduced for the other companies. And my request is, like many of them will feel the changes as too many. Let's understand, we are a key component of quality financial reporting in the country. We as professionals are a key part of improved governance in the country. And some of these, if they're going to help that cause, let's go and support that cause to be done. So let's not get into criticizing for the sake of criticizing. Some of these are very welcome and they'll help overall good governance and better asset utilization. Second is MSME disclosures on the face of balance sheet. Instead of sitting somewhere in the notes to accounts, on the face of balance sheet itself, how much are the dues to MSMEs and those which are disputed and those which are undisputed. As far as MSMEs are concerned, they're a vital part of economy. And if we have to meet the employment requirements of the country, large companies cannot create employment. Employment can be created only by the MSME sector. and that sector should be kept financially viable. And MSME sector, typically the large companies are likely to bully them. So they require a regulatory support to ensure timely payment for them. And this law has certainly helped the MSME organizations. Of course, many are still to get the full benefit of the legislation. And many of you might be aware, July 2020, government has revised the thresholds of MSME. And today, MSME's definition is so wide that it covers companies up to the size of 250 crores turnover. Earlier, it used to be 50 crores. Now, up to 250 crores, you are treated as an MSME. So, for MSME companies, if they are registered with MSME and have that certification, and they inform the person to whom they are supplying goods, 45th day money has to come. Otherwise, it has to come with interest, and it has to be reported. If you don't pay, it has to be reported on the face of balance sheet. No reasonable organization would like to have a situation of unpaid dues to vendors getting reflected in the balance sheet beyond the 45th day, because people will treat them as socially irresponsible. So that way, there's one other important disclosure which comes on the face of the balance sheet, so that people will feel ashamed if they have MSME dues so much, that feeling should be created. People should be responsible to make those payments to MSMEs. The third is registration and satisfaction of charges. So this is with reference to security created for assets. Assets when you borrow money from banking system, many occasions we come across the charge not being created on time, or when the loan is repaid, the charge satisfaction not being communicated on time. So here there's a requirement to report that we have created security as required. We have filed the satisfaction of charges as required. So all those disclosure requirements have been added. So the idea is the people who are engaging with the company, will know that these are the assets already given as security. These are assets which are free and they can take a suitable exposure. So this is another disclosure added. The next is entities with more than 2 layers of subsidiary. The Companies Act has a requirement, and this came again in 2013 amendment, where in the past we had situation where people would create any number of layers of subsidies. Money goes from A to B to C to D to E to F to A, and it went endless and the track was lost. Now you are required to have only 2 subsidiaries so that it's possible to reasonably maintain that particular track. So if any organization is more than 2 layers of subsidiary, you are required to report it as part of your financial statements. The next is compliance with the scheme of arrangement. So as far as the mergers and acquisitions are concerned, amalgamations are concerned, you are required to do the accounting for amalgamation as per AS 14. If it is Ind AS, we have standard code 103. And by law today, when you take the scheme to the court itself asks a certificate whether it is as per the accounting standards. But there are several schemes which still get approved where accounting is not as per the standards. So what this particular paragraph requires is you have to disclose saying that during the year there was an amalgamation and this amalgamation is not as per AS 14. Had we followed AS 14, this would be the revised figures of assets, liabilities and all. So that kind of a disclosure needs to be given. So that is another requirement which has been added. The next is working capital reconciliation. So the preparer of financial statement, auditor has to give, preparer also has to give. So the preparer of financial statement also has to tell that during the year, 30th June I filed stock statement with bank, 30th September I filed stock statement with bank. This stock statement is as per books of account If it is not as per books of account, this is the reconciliation. Reconciliation Q1, Q2, Q3, that reconciliation needs to be given. So that is another requirement which has been added here. And please note, as I said earlier, all these amendments came to facilitate auditors to report in CARO. Imagine if this para was not there. Suppose this working capital para was not there. For auditor to tell the client to give data and report would be impossible. But now that responsibility has been put on the preparer himself, where the preparer has to tell in the financial statements that this is the stock statements filed, they are tallying. If they are not tallying, this is the reconciliation. So that as an auditor, I can only verify. I need not bother about how to collect the data because it is the preparer's responsibility. Then it is about revaluation I mentioned earlier. So if the revaluation has an impact of more than 10% of the value increase, you are required to make specific disclosures and reconcile, and also give an assertion that it is as per the registered valuer's valuation. And on revaluation, just for your information, whether it is accounting standard 10, property plant equipment, or Ind AS 16, property plant equipment, these standards allow an organization to either follow cost model or revaluation model, either cost model or revaluation model. So if you are following the revaluation model, there are some principles laid down in AS 10 or Ind AS 16, how to periodically go through the revaluation. So all those details, you have to address it as part of this. And revaluation by registered valuer, whether it is in the case of property, plant equipment or intangible assets. So the next category of amendments in Schedule 3, and probably I'll pause after that for a break. So next category of amendments are relating to financial discipline and solvency. Financial discipline and solvency. First and foremost is you are required to give a set of ratios. There are about 10 or 12 ratios which you are required to give. And these ratios are not easy ratios to calculate. They are not like your intermediate exam ratios around. So here when you calculate ratios, many of us will have our own views on what will go into numerator and denominator. These are not standardized ratios across the world. Of course, guidance note which will come now will give you some inputs, but what you are required to do is, suppose I'm giving a ratio like current ratio, I'm supposed to give what all I considered in numerator current assets, what are all the items I considered in my denominator, and those numbers I should be able to tally it with the balance sheet numbers. So I should be able to sync it up with the balance sheet numbers. That is another requirement which has been added. And if the ratio has changed between last year to current year, if there's a 25% variation in ratio, then you have to again explain why there is a 25% variation in the ratio. For example, last year my net profit ratio was 6%. Now it has become 8%, which means 2 on 6, 33% change is there. You have to explain why that change in the ratio has happened. So that is one. Aging of trade receivables. As far as your receivables are concerned, you are required to give aging of trade receivables right up to 3 years and above. And please know, this is extremely dangerous. It is two things which they will see. One is, how have you satisfied yourself on collectibility? So if you're telling receivable is above 2 years, the minimum you have to get is confirmation of balance. If a customer is overdue for more than 2 years, which means that customer is dodging you, and confirmation of balance and all is very, very difficult. So as an auditor, you want to provide. As a preparer, client is not ready. How do you convince yourself? So these are all things not very easy. Earlier, we used to just give less than 180 days, above 180 days. Above 180 days can be even 1000 days. So that's how life was earlier. But now that is gone. You have to give the breakup 1 year, 2 years, 3 years. And once that breakup is given, as an auditor, for you to satisfy yourself on collectability, and tomorrow when regulator questions you, how did you satisfy yourself on collectability? Most likely the regulator will come 2 years later and this will still remain receivable then. And I'm telling you all this out of my practical experience. At that time, how do you satisfy us? Second is they will question your revenue recognition policy. Did you recognize revenue early, ahead of time? So customer believe revenue is accruing only after 2 years, but you recognized it much earlier and all. So is there a gap around that? So it's not going to be an easy journey there. So that again requires a very deep understanding by the client preparer for auditor to respond on that as well. Then aging of trade payables, I mentioned at the start, but let me tell you, trade payables and provision for expenses. Provision for expenses, continuously what you should have in your mind is the deposit rules. Deposit rules. If there are unpaid liabilities for more than 1 year, Ministry of Corporate Affairs will tell this is a deposit and violation of deposit rules. How do you satisfy yourself? Then aging of capital work in progress, including cost overrun. Cost overrun. So as far as your capital work in progress is concerned, all the time we come across situations where I thought the project will cost 150, it eventually became 170. So you have to explain why that extra 20 crores. All these years I never explained. But now you have to explain why that extra 20 crores. Now to explain extra 20, you should first have a good report in your hand on why 150. Why 150? So look at most of the client profile and all. What is the documentation available for any of the capital projects? It can be 10 crore project, 50 crore project, 100 crore project, depending on size of organizations. But there are several organizations I am aware where the documentation is pretty weak as far as your capital projects are concerned. So those cases, aging of capital work in progress, cost overrun, those details are to get. Please note all these are intended for improving the financial discipline and solvency of the organization. Next is transactions not recorded in books to be recorded here. How much of that has been recorded? Then accounting relating to CSR expenditure, end use of borrowed funds. So you are required to give an explanation of all the borrowed funds, whether I have used it for the purpose for which I have told. So I raised money saying that this loan is for capital expenditure. I should be able to demonstrate that the control process is such that I used it only for capital expenditure. If it is for working capital, then it should not go for capital expenditure. So that end use of funds, the preparer has to give, and auditor also should express an opinion on that. And please note, these are not easy. They look pretty simple on paper here. I took a term loan 20 crores. I bought capital expenditure. It's not so simple as that. Having a tight control process where you can actually do that mapping. Project borrowing, working capital borrowing, nothing should get interchanged. And if you look at most of the companies who fail, majority of companies who fail, they fail because of diversion of funds. Diversion of funds means long-term funds, use it for working capital, and more dangerous is using short-term funds for long-term uses. And it is all over the place. In fact, 95% of failed organizations, the single reason you will come across is working capital borrowings being used for capital expenditure. 95% of cases, my experience is because of that. You can keep telling entrepreneur it is bad, but they will not listen. They will say that any case it will come, but it will not come, and the companies will suffer. So this is one. Loans and advances to promoters and all, relatives and all, you have to have a full track as to where it has gone, including the end use. For example, if I give loan to a subsidiary for acquiring something at the parent company level, I should tell that I gave loan of 10 crores for acquiring a land and they actually used it for acquiring the parcel of land. So that kind of details I need to give. So end use of funds is being tracked and auditors to comment on it as well. So all of these clause amendments in Schedule 3 are intended for improving the financial discipline or solvency of the organization. I know it's difficult for organizations to follow, but if organization can dispassionately look and look at good organizations, they have always been doing this. Look at good organizations, they've always been doing this. It is the organizations which have been erratic who actually now find it difficult to fall in line. And then there are another category. What I'll do is I'll pause here, I'll come back and then we'll take up the remaining. So thank you all. So let's break. I think it's about 11:35. We reassemble at what are the time? 11:50.
ఇది పనిచేస్తుంది.
ఎవరున్నారు పెట్ట తిన్నా బిస్కెట్
అందరూ అడుగుతారు
అరే ఇగో వస్తుంది కదరా అలా ఏం చేయాలి ఎప్పుడైనా
వినాలి బర్త్డే జనవరి రావచ్చు ఎంత బాగా వచ్చింది అరే టీ తాగినప్పు టీ బిస్కెట్ తాగినప్పు ఓ జల్లు కదప్పు ఎవరో లేదా నా ఫోన్ తీసుకుంటాను ఎంత పెద్ద వీడియో పెట్టింది సూపర్ ఉంటుంది ఈ సైడ్ ఈ నుంచి మధ్యాహ్నం వస్తాను
ముప్పాల సునీల్ సార్ మస్తాన్ సార్
ఒక నేను డిజైన్ చేపిస్తా నువ్వు వేపించుకో నాకు మేలు రిజర్వేషన్ చేస్తా అప్పుడు కాస్ట్ వస్తుంది అప్పుడు చేసి ప్రయత్నం చేస్తా తీసుకున్నావు కదా ఎంత నువ్వు ప్లానింగ్
24th 1 year అని పాప. ఈ పాప తర్వాత శంకరన్ పాప వస్తుంది.
నీ పాప పుట్టారా శంకరకంటే నాకు చెప్పింది ఒకసారి కానీ
మార్చ్ లా సాయి గారి బిడ్డలు వస్తుంది కాబట్టి వన్ మంత్ ఈ ఫోటో కూడా ఇస్తారు మీ బ్యానర్ లా.
కరెక్ట్ చేసి పెట్టి నాకు మెయిల్ చేయరా ఆఫీస్లో ఉన్నట్టు మెయిల్ ఒకటోసారి సంతృప్తి
ఏమైంది ఏమైంది లేదు సార్ పొద్దున్న చేసి వచ్చాను. అదే ఇది ఆపే లైవ్ నడుస్తున్నాం సార్. ఆపినామంటే మళ్ళీ కొత్త లింక్ క్రియేట్ అవుతుంది.
వినబడకుండా మ్యూట్ లో పెట్టారా? స్వెటర్ తీసారా తెలియస్తుందా?
இப்பதான் வெள்ளைக்கு ஆரம்பிக்கிறானு சுப்பலட்சுமி இல்ல, இப்பதான் வெள்ளைக்கு ஆரம்பிக்கிறானுங்க. இப்பதான் சுத்தி திரானுங்க பாரு. இல்ல, இப்பதான் 10 மணிக்கு ஆரம்பிக்கிறான்னு போட்டிருக்கானுங்க. இப்பதான் இன்னும் இந்த ஸ்டேஜ்ல இருந்து அவன் போய் உட்காரல பாரு. மணி என்ன ஆகுதுப்பா? என்னவோ சொதப்பிட்டானுங்க தடவை. சவுண்டே வரல. இப்பதான் நம்ம குறுக்க நெருக்கியே போயிட்டு தர்றானுங்க. நம்ம உள்ளே முக்குறானுங்க. காசு எடுத்துக்கலாம் வேணா. காசு என்ன ஏடிஎம் எடுத்துக்கலாம். கூட்டு வேணா வரச்சுன்னா வச்சுக்கலாம்.
Request everyone to be seated. Please maintain silence. Keep your mobiles in silent mode. Thank you.
Let's get back to the remaining part of Schedule 3, and then I'll spend time on the other topic which I've been asked to speak. As far as the Schedule 3 amendments are concerned, the whole lot of amendments, I gave you the background, and they broadly fit into the following categorization, which I have done for understanding purpose. Two categories we just walked through. The third of the categories is relating to giving red flags to the ministry and for the external stakeholders to put them on alert that please be careful while dealing with the company. So there some of the amendments are in that direction. Some of these amendments are in that direction. So one of them is dealing with struck off companies. So under the Companies Act, whether it's the erstwhile Companies Act or the current Companies Act, if companies have remained inoperative, those companies are struck off from the register of companies of the Government of India. As far as these struck off companies are concerned, they are fairly large in number. And my own experience, particularly when I was in practice, there are many instances where entrepreneurs get up one day morning, they think that, okay, I want to do this. The first thing they would do is call up the auditor and tell, today I want the company to be incorporated. Today is an auspicious day, by 12:30 it should be done. So they put a huge pressure and get companies to be incorporated. But after the company is incorporated, their ideas don't take formal shape, they don't get executed. Like this, so many companies have been formed. Of the 14 lakh companies we have, there are at least 4 lakh companies which are lying dormant. They just got formed and there is no activity at all. So within the Companies Act, there are a certain set of criteria where the companies are struck off periodically from the register of companies maintained by the Ministry of Corporate Affairs. So what this provision says is, as a company, do I have any dealings with such struck off companies? For example, I might have sold some goods 3 years back before the company was struck off, and I am showing as a receivable. Or I have bought some goods which company is now struck off and I am showing as a payable. So as a preparer and later as an auditor, I have to express an opinion whether there are any transactions with such struck off companies. So we go to the MCA website, there's a list of such companies available. You have to download that whole list and check your vendor base, your customer base, and see whether any of those names are tallying. And if there are any such transactions you come across, you are required to make a report of the same. So this is one of those red flag items which have been added as part of Schedule 3 amendments. So another of the Schedule 3 amendments is regarding Benami transactions, where some transactions are done in the name of other parties or some assets are acquired in other parties. And we have a separate law relating to Benami. And in case a company has been found guilty of any Benami actions and all, so those details you need to give it as part of your financial statements. To be very honest, this will be the first year. It will be exciting to really see how companies are going to report on this. At least most of these companies, the companies which are what we popularly call as shell companies, or companies which have been formed for the sake of money laundering and all, how they will go and report under these requirements, we have to wait and see. But what the law requires is, if any transactions relating to you are done in somebody else's name, or there is a legal case going on in your name, saying that you have pursued some Benami action or encouraged the Benami action, you are required to give a disclosure of the same. The third of it is immovable property not held in company's name. I mentioned to you in the context of Caro. So if properties are not in your name, you have to give a list of those assets, why it is not held in your name, you have to give. And please note, some of them can be genuine. I gave you the example of Sunil selling me on 28th and I registered it only in the month of May or June. 31st March, it will not be in my name. So there can be genuine transactions also. But what it says is, at least tell everybody that here is an asset where it is still not coming to your name. willful default declaration. So as far as the Reserve Bank of India is concerned, they have given some guidelines on when a borrower is to be treated as a willful defaulter. So if a particular entity has been identified as willful defaulter, you have to disclose in your financial statements that that is X Limited, have been classified as a willful defaulter by so and so banks as per the RBI guidelines so and so. That disclosure needs to be given. Then loans given or loans received from other entities. So this is a very important one, where what it says is whether it is in respect of amount borrowed or with reference to amounts which are lent, you should have a control process on the end use of the funds. So I borrowed money for a particular purpose, I should demonstrate usage for that purpose. Or if I have given a loan to somebody for a particular purpose, has he or she used it for that particular purpose? So I have to have a control process to satisfy myself. And please note, all these can't work on management representation letters. Many people think that we'll simply collect management representation letters and based on that we will sign. On MRL, I want to make a small observation. Management representation letter is as good as a toilet paper. Unless there is evidence of two things. Evidence number one, that you have verified the contents of management representation letter. So there should be evidence in your audit working papers that if the management has made 15 representations, I have verified those representations. That evidence should be there. Second requirement, SA 700. When you are finally forming your opinion, SA 700, there should be working paper. There should be evidence that I have considered the contents of the management representation letter in forming my opinion. So there should be evidence of the fact that this contents are relied upon for the purpose of forming the opinion. Only if these two things are there, management representation letter has an acceptance. Otherwise, it is not an acceptance document. I've come across several cases in the institute review process and discipline process. People have collected MRL as a religious activity, just put it in the file. That will not help at all. There should be clear evidence available in the working papers on two aspects, both of which I mentioned to you. So this is one such area. And last is, if a company is dealings in cryptocurrency, as far as India is concerned, we are in a very peculiar stage where we don't know whether it is legal, illegal, prohibited, not prohibited. So all of us have our own views on the crypto assets, whether they can deal with or not. So what this paragraph says is, if you are dealing in crypto assets, either you have bought, sold, gained, lost, holding it, you have to give a disclosure of the transactions which you have had in crypto assets, how much is the gain or loss you have incurred, all those details needs to be given. So that is another amendment which is there. The last category of amendments are hygiene amendments. The fourth category of amendments in Schedule 3 are hygiene amendments. They are more edits which are done for grammatical corrections, etc. So first of it is rounding off. So as far as rounding off is concerned, up to 100 crore turnover, above 100 crore turnover and all, we have some rounding off criteria. But as far as the word turnover is concerned, it is not fully representative of size of the company, because there are many organizations who have gains and other income which is fairly substantial. So instead of the word turnover, they have replaced it in the word total income. So the criteria of rounding off, whether you should round off in lakhs, thousands, millions, or round off in lakhs, crores and all. So that criteria is based on whether your income is above 100 crores or below 100 crores. Earlier it was turnover, now it is called as income. Then the third minor amendment is, in the case of Section 8 companies, there are grants, donations, subsidies which come. So all those grants, donations, subsidies are to be included as part of your income. So that's one presentation layer which they have added. The fourth is security deposits which are given. So most organizations as part of their day-to-day business give security deposits for various purposes. Those security deposits earlier were all treated as part of loans and advances. You are now required to remove it from loans and advances and show it as part of other current assets. The reason is loans and advances basically have a repayment requirement, etc. Security deposit is more about just giving somebody assurance or a fallback mechanism. Consequently, it is not loans and advances. Depending on whether it's short term, long term or not, they'll go to current, non-current classification. The next is the word tangible assets is now replaced by the word property, plant, equipment. So earlier Schedule 3 for fixed assets, they had the terminology called tangible assets. That is now replaced because accounting standard 10 uses the word property, plant, equipment. That's a small editorial correction which they have done. Similarly, for Ind AS companies, when you come to leases, for Ind AS companies, whenever you take a lease, asset on lease as a lessee, you have to recognize a right to use asset and a liability. So this lease liability, where should it be shown? So there is no clarity on where it should be shown. So they have now amended to add that lease liabilities need to be shown as part of borrowing separately as a line item. So that additional disclosure has been added. Next is on statement of changes in equity. Statement of changes in equity is nothing but statement of changes of shareholders funds. Opening, addition, utilization, closing. Share capital, P&L, general reserve, revaluation reserve, this, that, and all. So that's a statement which shows how your shareholders funds are moved during the year. So on that statement of changes in equity, they have made one amendment because in Ind AS with reference to error. Suppose I discover an error in current year 21-22 and that error relates to 1920. That error relates to 1920. Ind AS 8 requires you to go and prepare what we call as a third balance sheet. Requires you to go and prepare what is called as third balance sheet. You will prepare balance sheet for 31st March 22 current year, previous year 31st March 21, and one more balance sheet 1st March 20. And the error of 1920, you have to adjust in the opening reserves of 1st April 2020. So for this reason, they have added an extra column. So if there are errors, those errors which you have adjusted should be shown separately in the statement of changes in equity. So those are all editorial corrections. Why they are called editorial corrections? Because 99% of cases, even if this correction is not there, that is what we would have done. Even if it is not there, 99%, that's what we would have done. So that's a correction which is done. And lastly, for non-banking finance companies, there's a requirement of disclosing what is your capital adequacy ratio and give some additional ratio disclosures. So this is broadly about the Schedule 3 amendments. Individual details are all available in these subsequent slides. I have more or less explained all of these changes as I walked you through. I'll be leaving behind a copy of this deck with the branch, and that will be made available to all of you in whatever form of dissemination which is there. So with this, I would like to complete my discussion or introduction on CARO and Schedule 3 amendments. If any of you have any specific queries, please feel free to ask, and then I'll go to the other topic. So, any questions on Schedule 3 or CARO before I can go to? I think I've covered everything. I don't think I left out anything.
Rounding off is mandatory, sir.
Mandatory. Rounding.
So there's no choice there.
There is no choice. No. Because that is not the proper reference. Mandatory.
How can we ensure that undisclosed?
Much of the other places. Okay. There's a good question. How do we ensure that undisclosed income is reported in the financial statements? First and foremost, while performing the audit, you have gone through the tax assessments that the organization has gone through, and that will give you an idea of whether there was any income which has been concealed, whether it has been disclosed. So first, it is an obligation of the company to disclose it. So company has to disclose because you can't pay tax without income coming into books. So it first bring the income into books, create the corresponding asset or reduce the liability, and then pay the tax. So that is what is required in schedule. As an auditor, I have to comment whether this accounting has been done correctly. So the source is essentially your tax assessment and other tax related business.
What is the tool available in the hands of auditor to know the Benami transaction? Under the guide tells to do very.
That I agree. Other is the notices received by the company on Benami transactions. So these are the two ways.
On our own, we cannot.
Very difficult. No? So just like fraud. Fraud and all, most cases you discover it accidentally. You actually focus on preventing a fraud or have controls which will help detecting. But frauds are always ingeniously done that you actually discover it very accidentally. So till it comes to light, it is there. Yeah. You want to display financial ratios?
Not that reason, sir. The Minister of State is certificate to more than. Particularly, that is not being taken.
You mean inter-service coverage ratio?
And bankers interest are not being taken. On one go, we are seeing this ratio, some risk of the and what is that a stakeholder can do?
Okay.
Let us say current ratio is 0.25. What is the current rate? 1.3. So currently, what is the 0.5? What is the stakeholder can do? If you are expecting this to be solved by saying the current ratio is 5.
I'll respond. Yes. Okay. So please listen. So there are two very. I'll come back to you. The two very interesting observations again out of this vast practical experience. First and foremost is the number of ratios are fairly limited, and there are some key ratios which the banking system usually uses, like inter-service coverage ratio, gain ratio, etc. Probably those could have been added. As far as that discussion is concerned, it is an endless discussion, sir. I'll tell you why. As far as the ratios are concerned, first and foremost, probably we are the only country in the world where we have actually brought in ratios as part of the financial statements. It is for the users to do their analysis and do it. Ratios is basically a tool for analysis. Ratios is a tool for analyzing financial statements. But the government felt some of these ratios will help give some red flags. And on ratios are concerned, sir, there are no standard ratios which we can say that if it is 2:1, it is good, 1.33, it is good. It is a function of several things. When it comes to ratios, it is a function of the date on which the financial statements are prepared. It is that organization's operating cycle which is also to be taken into account. And it is also the age of the organization to be taken. There's so many factors. So these ratios consequently are a limited number of ratios. And I would say it is a pilot initiative of MCA that some solvency ratios, some profitability ratios, some return on investment ratios are captured. So that is a pilot project and it is not a complete set. Does it prohibit an organization from giving additional ratios? No. Organizations can voluntarily choose to do it. And I also want to caution that whether it is MCA or the Institute Guidance Note, we still have difficulty on how these ratios can be calculated by all of us uniformly. Like, for example, current assets. What all should be included inside current assets? It's a question mark. For banks and all, we prepare it in a particular way. we explain to the banks and all. But here, when you're expressing an opinion, it's not so very easy to tell what should go into numerator. And theoretically, all of us can come, but we can't freeze them. So, and the same is true for most of the ratios. Net profit ratio, you remove exceptional items, extraordinary items, all the discussion becomes endless. So I think it is initial days. What they said is, whatever you calculate, you tell what you took in numerator, you tell what you took in denominator, and give the ratio. So this is an initial part. The second question is a valid question which you asked. The second question what you asked is, acceptable ratio is, let us say, 1.33 for current ratio, but the actual is only 0.75. Actual is only 0.75. Now, what is it that the stakeholder can do? What is it that the stakeholder can do on it? If you recall, I put that in a bucket called improving financial discipline. Improving financial discipline. So the idea of this is to tell the external world that, look, you are dealing with a company where there is a short-term solvency risk. So external stakeholder who is dealing with the company is put on alert saying that current ratio is only 0.75. Do you still want to transact with the company? Do you still want to deal with the company? So bankers, do they want to engage with the company? It is their call. But at least I have told you that I have this problem. I have told you that I have this problem. If you still want to deal with me, you are an informed person. It's like, let the buyer be aware. I cannot protect everybody in a business world. I can only tell that these are all the things which are there. If you still want to deal with me, I can deal with it. I'll give a small example, probably not to quote, not to really take it in the literal sense. I'll not give the name of the companies, but you all know. We know that there are for certain business houses or certain business organizations, we know they are badly managed. We know those organizations will collapse someday. We know whether it is the other brother of a person, and that's the maximum I can give, or an organization flying. So we all know right from beginning, the way they conduct their business, we know they will fail. But have people stop transacting with the companies? The answer is no. So with knowing fully well, people transact. And look at the number of financial schemes which are there. When somebody tells, I'll give a return of 24%, and somebody still goes and puts there, it's just impossible. Now, can I tell that person don't put there? He'll laugh at me. I'm literally telling you, people have laughed at us saying that, why are you advising us like this? We tell, look, inflation is only 7-8%. You can maximum get a reward of another 2-3%. Don't expect beyond it. No. You don't know how to manage your money and all. I know I'll buy land which is there outside there. I'll do all that. That land will come with 20 title disputes. You tell how much ever you tell, people will do that because they believe somebody else has made money on the basis. So my view, sir, as far as the MCA is concerned, we can only put it on alert basis. If people are not acting on the alert, I don't think we can protect everybody like that. I'll give you a small example, sir. My complaint with MCA is that if you look at most of the organizations who have failed, Caro, there have been so many negative observations. Had MCA taken action on time, probably some damage could have been stopped. But the truth is, there's only so much administrative bandwidth also. Now, I think they're going in the right track. I think with the new IT tools and artificial intelligence, I think it will eventually improve. And my own personal experience, and you'll agree, sir, between 90s when I started my career to now, I think we have traveled a long way. Governance has certainly improved. Can it be much better? Answer is yes. But I don't think we have gone backward. I don't think we have gone backward as a nation. We have certainly moved forward, and from there we'll only get better. So that's my short answer. Please, welcome, sir. Please. Ratios, sir. Slides are about. Yes, sir.
When you give a blood sample to a dietitian center, how you get the reports? You get the results. We compare with the standard.
Correct.
We give the actual results.
They give a range also.
See the question. That's the person with the question. Where it is when it starts. Suppose you compare the standard which is not that. and constitute. A personal suggestion is there itself. You can vote it or not. My suggestion is against all the actual business. You can do the transaction. And actually, the audit data or data was
Let me go there.
capital.
Let me go there. So can I respond on this point which you mentioned? As far as the standard ratios are concerned, sir, they're highly industry specific, operating cycle specific, and age of the organization specific, function of accounting policies which are there, like cost model, revaluation model. So unlike in the case of a blood sample report, where they give it should be in the range of so much and all, there also, let me tell you, I would discourage a patient to make an inference based on that report.
Have an idea.
Sir, that half, no, sir, with all due respect, that half knowledge is far more dangerous than the having from no, I'm just giving a view. This topic will not end. This topic will not end. But point is taken. Point is taken.
Medical report is also for the patient, but here the report is not for the company, but for outside.
As far as the medical report or anything is concerned, it is supposed to be used by an informed person. Like, let's say, for example, I go for a patient, I get some report. If I start trying to read that report, I'll try to do with Google and all. That's not going to be successful. You only end up with a wrong diagnosis. So similarly, when you analyze financial statements, it's a highly specialized job. It's not a job where anyone can analyze the financial statement. It takes ages of experience to understand how the interplay between accounting policies, industry features, all of them interplay. Only then you can form an opinion on that. So, point in, your intent is good, but the question is practically how to implement. We have to think through more. I am not disputing your intent. Intent is good. It definitely helps people to tell that standard ratio is 1.33, 1.75.
Not for the companies, it is for stakeholders.
All the more you should be careful, sir. All the more you should be careful. But point taken, sir. I have heard you. Point taken. Point taken. Okay. I'll go to capital version. Yes, sir. Is that it? Yeah.
Just for a while, you are not a parent.
Yes.
You are a stakeholder. Seeing the tables, what is that you can understand? What is that?
That's a very good question, and maybe more particularly since students are there, I think I should give clarity on that. As far as financial statements are concerned, they are not, I reiterate, they are not meant for common persons. They are not meant. In the framework of accounting, we have a very specific input that financial statements are meant only for people who have a reasonable knowledge of financial statements. It is not meant for everyone. It's meant only for those who have reasonable knowledge. Now, the expression capital work in progress, it is understood that a person with reasonable financial knowledge will know it and the aging of it. So your point is very taken, sir, very well taken. But this is an argument I keep coming regularly.
You want to convey this statement to the stakeholders.
Stakeholders, I'll explain that. What it says is, as far as capital work in progress is concerned, there are many projects where the projects have actually not commenced. You have done halfway, 3/4 way. And what is happening during this period is you are capitalizing all the expenses there, which should have actually gone as loss, and the net worth would have got eroded. So what this table says is two things. One, your capital work in progress, how much time it is taking before it gets completed. So let us say capital work in progress is there for above 3 years. Now, above 3 years for setting a steel plant, understandable. Above for a refinery, understandable. But let us say for somebody who is setting up a textile mill, there is no way it should be about 3 years. No way it should be about 3 years. So the idea of giving this aging is for the users to know how much is the time it is taking before it's getting converted into productive asset. The second information they have added is the cost overrun and the time overrun. So that is the purpose. Yes.
The time of completion is not given. Estimated time of completion is not given.
It is there in the next requirement, sir. Time overrun. So the time overrun, what they are telling is, it's there in schedule 3.
What is the time of?
Time overrun, what they said is, if the original planned schedule is 18 months, but you actually take 24 months, then you have to tell that so much of the capital work in progress, there is a time overrun. So you're required to give both time overrun as well as cost overrun. So that point is covered.
Here I have a solution.
Yes, sir, please.
When we submit the project report, financial
Back.
institution, we use schedule of implementation project in detail. And the project is referred to the technical study. They study movements.
Correct.
They even use of factory system.
Correct.
If this same statement is given in comparison with the schedule of implementation.
Obviously, it has to be only like that, sir. It cannot be different.
No, sir. How it is given in comparison with the schedule of implementation in all aspects. So, the stakeholder in the position, sir. Here the stakeholder is the one who is interested in the topic.
100%. 100%. That's exactly what this will do, sir.
Even in comparison with the schedule of implementation, that was
100%.
authorized, that was authorized
By the board.
by the financial
Exactly.
institution.
Exactly.
Then the stakeholder is in a position where it stands. Is it because of planning? Is it because of approvals? Is it because of an approvals?
Exactly.
If it is position.
This is exactly that only, sir.
But where is the schedule of implementation not given as well?
Sir, you need not give the schedule in terms of micro details. What it says is, if the schedule is to complete in 18 months, and if you have crossed 18 months, then you have to give it. So it does not go to the extent of saying that reproduce the schedule per chart and all. That is not required. So, but
We should have schedule of in comparison.
yes, 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 yes. Yes, yes.
As with the plan.
Yes, yes, yes.
As the.
Yes, yes, yes.
Where the project is delayed.
Exactly.
When the project is delayed.
100%. That's exactly the intent. Except that we don't give micro level details, which the schedule of third month is the progress, fifth month progress, that is not there. But if the original schedule is 18 months, now 24 months, tell that it took extra 6 months. Is it because of machinery supply? Is it because of civil work getting delayed? Is it because of approvals not coming? So you have to explain those reasons. It's captured. And it is there, sir. It is there. What is not there is month-wise schedule. That is not there. No, no, it's 4 schedule is there. It is there. It is there, sir. It is there in the next.
Where exactly is delayed? Is implementation.
Yes, yes. The reasons for delay you are supposed to give. That reasons for delay are typically the reasons which you mentioned.
Is it because of election?
Yes, 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 yes. It is there, sir. The schedule 3 does not tell these are the possible reasons. It tells give reasons. So we have to give reasons, sir. So suppose schedule 3 has 3 reasons, we will fit into those 3 reasons. So it tells give reasons of why time overrun, reasons of why cost overrun. It is there, sir. It's there. It's already there. It's there. My view also is we have made one jump, sir. One up. Just imagine without this versus this. We have made one progress. So if you can't,
One is, I'm sorry.
please, 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 please.
The main object of all these efforts is to see that the stakeholder has been.
100%.
These are two.
100%.
Not the MC, not the auditor. We are not satisfying the balance sheet for the sake of audit.
100%.
I'm not giving.
100%, 100%.
No
No
discussion.
discussion.
Of final piece.
Correct, 100%.
Yes.
100%.
And you know, the present position of the impacts and I can tell you. We have lacked the concepts in the format of money. It's causing the cost of lakhs of funds. Which today I can prove that the balance sheet what we have is lakhs. Can we tell you what this is? Why is that we don't have a doing short-term liabilities? That is the reason why the driver wants diversion. When it's not disclosed, there is a omission concealment of fact. Once diversion, what can be disclosed and that short-term approach. It's not a pay, it's not a pay. It's getting disclosed under the head current accounts, under the security. Suppose the money invested was diverted, diverted money invested in capital market or a subsidy account. Where we declare that we declare that non-current. However, corresponding language. That is why it's not getting disclosed under that. The current asset, non-current asset, invested capital market, and the non-current asset. Automatically, the corresponding language becomes a non-current asset. But we don't approach it. What the CS, what the companies have been doing, they are continuing the same in the current liabilities as a secure. It's not secure also. When the fund is diverted to the capital market, when capital market has not hypothecated, the charge has not been created, that in that case,
The point taken, sir.
corresponding liability becomes non-current liability.
The point is taken.
That's their balance sheet, the format of balance sheet, tax conference research. We have started to read the words. We know deals, literal, receiving, recording, and stakeholder, banking leadership. We are the chief, but we must be made responsible for whatever the losses, banking, campaign, tax of course, we are the professionals in accountancy. Don't do. Can we expect any other person?
Sir, I think it's
Can we
a,
expect any other professional?
can I make an observation and we close this discussion? As far as the banking,
I'm sorry.
no, sir, perfectly fine. No, sir.
Being a single person.
No,
I want to take this issue to the institution.
I've heard you fully.
As like that we don't justify the statement of the.
I've heard you fully, and I want to tell you that in terms of the detail of balance sheet presentation, take India versus rest of the world, we are ahead of them. Second point. The banking system's efficiency is a separate discussion to be had, not now. So as far as banking system is concerned, we all know how it is functioning and how much data they have, despite that how loads of it. We'll discuss that separately, sir, not on this one. You had some question. Yeah.
Question on limit of exposure, putting the deal with the sum of company. Now, suppose if the company is struck off during the period, I can see the amendment says that they are supposed to reporting the balance sheet items. Now, if the company was struck off during the after August, but before that we have had transaction with them and they were settled. Now we have no balance outstanding. But are we required to disclose the transaction as well? Because in some companies we have seen that Paytm, IHP, they have disclosed the transaction. But whereas in some companies they are not disclosing the transaction and they are only.
You are required to give those companies which have been stuck off during the year. You need to give. Yes. The idea is whether that was a mechanism for diversion and all. So it's in that context. The guidance note will give you a response on that. Yeah. Yes.
Is there any justification calling for opinion from the chartered accountants who are not despite of the fixed assets?
Opinion on what it is.
Fixed assets, whether it is on their name or something like that.
Sir,
The bankers are finance. Bankers are also controlled by the RBI. That it is the library to comment on they represent the state. But we are not technically qualified. It's simply that is on the name of the firms. There may be some implications of other things.
sir, as far as that part is concerned, the audit standards give you enough support for you to rely on an expert. So audit standards allow you.
As per the opinion
Yes,
given by
yes,
the
yes.
advisor.
But, as I told you, like MRL, this legal opinions will not serve you purpose unless you fulfill two things. One, you should be sure about the competency of the legal advisor. Like for example, some people will go to a legal advisor who is not practicing in the area of titles and get that opinion. That opinion as an auditor I should not rely upon. Point number one. That is all available in the audit standards. The second point is, when I form my opinion, there should be evidence that I relied on this opinion for forming the opinion. So that evidence should be. So, and it is very important, auditor should take responsibility. That's precisely what he is saying. As an auditor, I should not disown that responsibility because I am telling this is an asset of the organization. So if the title deed is not there, I need to be convinced that eventually I'll get ownership. Otherwise, it's an expenditure. No? So as an auditor, that much responsibility we need to take. We need to take that.
When it is not technically qualified, why can't it
Then
be
many
given
cases
to the
where-
bankers?
No, 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 no,
Bankers
no,
also
no, no,
support
no,
to
no,
the
no.
RBI.
No, no, but
So
we are,
select on.
no, like that, we are not technically qualified on actual valuation. We are not technically qualified on many valuation aspects. But what do? We rely on the subject matter expert and then form a opinion. So same thing is happening. So let's move on to the last topic. I think we have, yeah, please. Schedule, please, schedule. Yeah.
With this clause, aren't we making a hindrance for MSMEs for getting their contracts from big organizations?
That's a practical question all of us go through. So there are different practices which people follow. So many MSMEs out of this fear, they don't either register or even if they register, they don't tell the client that I am an MSME. So that's a practical problem people have. That is why we go back to that initial starting of triple bottom line and inclusive one. So we have to take the society as well. So as far as MSMEs are concerned, it's an organization's culture of how are we supporting the MSMEs. And my view, there is a reasonably good progress over a period of time. I won't say that all organizations are having good practices in MSME payments or not, but it is this law has certainly helped the MSME sector and it will help more in time to come. So like every legislation, that implementation is a function of the parties who are involved in it. So here both parties have a responsibility to function there. Your point is valid. Point is valid.
So adding to that question, is the payment for the MSME is mandatory or I can disclose that?
It is mandatory actually. Otherwise, after that, it's an 18% interest now.
We are not asking the payment.
No, MSME by law, 45 days you have to pay.
RBI interested if I don't pay
RBI interested for what?
for not making the payment. Someone asked me, why did you pay? I wanted to pay. If I have asked an invoice from the MSME, but they are not raising it.
So then it is not due. We are talking about dues. Once the due is established, from there 45 days. If somebody has supplied, you have made a provision, but invoice has not come, you are not. So those are all some practical issues. From the time of invoicing, 45th day payment has to be done. My view, 45 days. Even if you pay in 120 days, that sector will be a happy sector. And my view, that sector, we should encourage that sector to grow. Because my view, that is the only sector which can create employment generation and economic activity. So this law is like that. Yes, sir. It's a legal liability, but nobody is providing. Nobody is providing. But we are also citing the sir. So that's exactly his point. I have been exchanging mails with him. He keeps telling this. So the point is, the practices have not improved. The law has some intent, but practice have not improved. Okay, so let's get back to the last topic. I have a hard close at 1 o'clock because I don't want to eat your time after that, and we should have the benefit of next session. This is a light topic called virtual CFO. And for the young minds, that might be a very exciting opportunity. You might find it very interesting. Some of you might like to pursue that path. But let me share with you what this concept of virtual CFO is all about. As far as the chartered accountants in practice are concerned, my experience right from my articleship days, chartered accountants have always been acting as advisors to their clients, despite conflict of interest. Almost all chartered accountants for their clients, they act as advisors. Every small, medium organization, any transaction relating to capital infusion, anything relating to expansion, anything relating to borrowing, anything relating to distribution, anything relating to exploring new markets. The entrepreneur, I have always seen, has always consulted the chartered accountant in practice before he or she has taken up that activity. It's so very common, so very common. So chartered accountants acting as counselors, finance counselors, has been there always, except that it has evolved today to such an extent that it has got branded as a separate offering, a separate service. And in my view, these are all evidences of maturity curve. Recall, I told you there is always this conflict of interest. I am an auditor of a partnership firm, auditor of a private limited company, and the client asked me, can I raise capital in this particular way, this type of convertible instrument? Can I pay dividend? There is obviously a conflict of interest, because later I need to express an opinion on whatever I have advised him, which he might follow, So over time, it has now got identified as a service, and which also used to be a free service. In fact, for most clients, this kind of advice was more an advice for client retention as a client service. But now it has now got branded as a service, and the clients are also ready to pay for that service. So we have come to that situation now. As far as the CFOs are concerned, I'll spend a little time on what is the profile or activities of CFO and how, as chartered accountants, we can bridge that gap. My entire discussion will be around virtual CFOs for small, medium enterprises. For large companies, full-time CFO is essential, is a must. But for small, medium enterprises, if somebody who has that finance background, appreciation of financial impact, and can guide an appropriate financial strategy, that's a huge value add for the small, medium enterprises. Most of the small, medium enterprises fail because of wrong financial decisions. Financial decisions like using short-term money for long-term purposes, financial decisions like paying excessive dividend, financial decisions like taking up projects where the viability risks have not been assessed properly, or they are scaling up very fast at the rate of 20-30% without having appropriate internal controls. So different reasons these small medium enterprises collapse. Good business models, but they collapse because there's nobody actually guiding them on several of these matters. For these organizations, if there can be somebody who can fill in that gap, it will help those organizations to sustain and be successful. But for these organizations, getting a person on a full-time basis is a dream. Nobody would like to. Any chartered accountant or any full-time professional will not like it much to engage on a full-time job for a 20 crore business, 50 crore business, 200 crore business, and be a CFO for those. You don't have so much work. You don't get so much exposure. So it's very difficult to have people who can come and give this particular service. So what has evolved over time is this branded offering where a single chartered accountant or his organization, I would strongly recommend an organization, a chartered accountant organization, to offer that suite of CFO services where for 2 clients or 3 clients, you take responsibility of their entire finance function, accounting function, tax function, whatever allied functions. you take full responsibility and run it I'd strongly recommend, don't become victims of temptation of doing it for audit clientele or also doing audit for the same clientele. Please do not become victims of that. I would suggest, if you are a virtual CFO for 3 organizations, let some known person do the audit or friend, whatever you want to refer. That person will have some other opportunity which he will refer to you rather than you trying to do everything. This is a common mistake which I've come across many people doing it. Now, as far as virtual CFOs are concerned, this particular suite, as I just mentioned, is largely meant for the small medium enterprises, and I would encourage it more for the top end of the SME segment. I would not encourage it for the smaller companies as well. I would not encourage a CFO type of a role for the bottom end or even the middle size SME. I would encourage it only for the top end of the SME. The reason is, for the bottom and middle end of SME, once you have a full-time CFO and all, or somebody giving so much time, it will actually become a constraint on the business, I'm a strong believer of 80-20 principle. As far as the smaller organizations are concerned, 20 crore business, 50 crore business, 70 crore business, I am a strong believer that those businesses, you should allow them to run on their own. Don't try to put too much overheads, controls, processes and kill them. You should allow them to gradually grow. Once they come to a size, then you have to put all those controls and processes. When organizations are small, it's important to be agile, nimble. They should move very fast. You can't go and implement segregation of duties and tell two people, one person should raise the bill, other should approve it, and another sign the check. Those things are all overhead which will kill those organizations. So you should allow organizations to grow. So my own view is that these roles are best suited for the top end of the small medium enterprises. Now, as far as the small medium enterprise are concerned, that's a huge segment of the economy, growing pretty fast, diverse industries, huge asset base, maximum employment created, all of those statistics. So for most of the chartered accountants in practice, taking up responsibilities of a virtual CFO for 1 or 2 clients or 2 or 3 clients is something which is a huge value add you can give, and it also gives you a recurring revenue, The only one additional observation I would like to add is, please do not take up this service as an individual, take it as a team of people within the organization. While an individual will be the face, there should be a team who should support you to deliver the expectations of the particular client. So small medium segment is an enterprise market segment where there are enough opportunities which are there. And this is a segment which is receiving a very high amount of support in the ecosystem, which includes a platform in the Bombay Stock Exchange, the National Stock Exchange, for listing of small medium enterprises and raising risk capital. For most of the small medium enterprises, for them to grow, access to equity capital becomes difficult. So one choice is to go for private equity and all, but private equity comes with so many conditions that many times it is difficult to function with that kind of a private equity. So you have this SME segment which is there on the stock exchange, and now have about 300 companies or so listed there. And there are many success stories. I'm fortunate to be part of one such company which has benefited from the small medium platform. Because for these entrepreneurs, if you get a private equity guy for 25-30% shareholding, the private equity people will literally choke you and make life very difficult to function. It's not easy to function with a partner like a private equity investor. But if you have a set of retail investors, and in the SEBI guidelines, there are some restrictions regarding minimum lot size and all. So which means the profile of investors are informed investors. The minimum ticket size you have to invest is about 100,000 rupees. 100,000. So which means you don't get the small investors, you get only the fairly large retail investors. Let's say, for example, there are many professionals and many business people and all. So if there's a reasonably good SME, they will not hesitate to invest 2 lakh rupees, invest 5 lakh rupees and earn some dividend income and potential capital appreciation. So this small medium exchange platform has been fairly successful, and some of those companies have actually gone to the main board of the stock exchange also subsequently. So the virtual CFO has one important opportunity in enabling these small medium enterprises to go to the capital market and raise that important risk capital requirement which is there. Then these are some statistics. This is very important. This is very important. Almost everyday headlines, they come across unicorns. Unicorns are all those $1 billion valuation enterprises. Now, if you look at the unicorns of this year in India, we had a very large number of $1 billion unicorns which have come up. Those valuations, some of them will fail and all. It's a capital market economy. Some of them will fail. Some of them will fail. Some of them, I'm repeating, will fail. But investors also know, they're also betting. They're also saying that if there are 10 investments, 3 will succeed, 7 will fail, doesn't matter, but it will cover the remaining 7. So there are these unicorns also coming. Now, who are these unicorns? Unicorns typically are those startups. And these startups are organizations with a 3-year-old, 4-year-old, 5-year-old. And these organizations are typically small, medium enterprises. These unicorns are all companies which have a turnover of 50 crores, 150 crores, 200 crores, cash loss of 60 crores, cash loss of 600 crores, sometimes more the cash loss, more the valuation. So all those kind of combinations are all happening. So those are all business models, valuation, investment, that's a different segment. But every unicorn which you have today has recently been a small, medium enterprise. Everybody who is a unicorn now, a year back, 2 years back, was a small, medium enterprise. And that is where the opportunity lies for you to be part of the journey of that unicorn success, and whatever you have also benefit from that experience and the income stream which you may have. So that unicorn ecosystem is also going, and globally as well. If you look at even a US market, we know particularly from the state of Andhra, Telangana, a very large population of them are based in US. In fact, some parts of US, if you go, you will actually lose a fact of whether you are in US or in Gachibowli. So that is the feeling you will get when you go to some places of US. So despite the fact that there's a very small population of Indians there, about 1.5% of Indians are in US. Of the unicorns in US, almost 23-24% of unicorns are those which are being promoted by the Indians. And that's the ecosystem in which all of us are living. And these are all unicorns where, and almost all of them in unicorns in US have back office operations, have fairly senior management operations based in Bangalore, Hyderabad and all. So that is about the ecosystem where you can actually participate. And given this backdrop of all the small, medium enterprise which are there, the organizations require the CFOs for several reasons they require. One of the most common reasons why people try to look at CFOs is for capital raising. That's a very common impression people have. CFOs means they'll help raise capital, they'll help get money. So there are people who have access to relationships, they have credibility for relationships, and they get it. While that is one expectation, there are several other things also which a CFO is required to contribute, which includes helping the entrepreneur in better understanding of financial matters. In fact, most of the small medium entrepreneurs are hardcore engineers. They worked in some company for 10 years, 15 years. They hardly understand finances. They hardly understand cost sheet. They hardly understand pricing. So there is no. Yeah, hardcore engineers. A lot of them. Almost every small medium enterprise. If you come to Chennai, if you look at all the automobile components, everybody is an engineer. They worked in some company for 10 years, then come and start a small ancillary unit. So all of them require someone who has a good understanding of financial matters, because ultimately business is measured in terms of money. So somebody has to provide that insights, and that insights is best provided by this person. Then third role is advice relating to financial decisions, whether we should raise capital, whether we should raise debt, how much we should dilute. Should I dilute my shareholding 5%, 10%? Should I issue a vanilla equity instrument or a convertible instrument? How should the convertible be structured? Or when should I pay the dividend? How much dividend should I pay? All these kind of decisions are advice on which this gentleman can contribute. And then very important is to build credibility for an organization. And my view, more often than not, CFOs become the face of the organization with the investor community and the banking community. While the promoter is there, while the CEO is there, more often than not, the CFO becomes the face for the investors, for the bankers, and for the other financial stakeholders. So that person needs to bring that kind of credibility. So he should be so credible that when he speaks, the other person should be able to listen without discounting much of what he is saying. People will discount, but without discounting much of what the other person says. So that credibility is what he or she needs to bring to the table, and also help the organization to survive the competition and stay ahead. And as far as the virtual CFO concept is concerned, I just want to add again from my experience. There are many organizations who are now ready to invest in a virtual CFO for two reasons. One, the small medium enterprises profile, if you look at them, many of them, either they are second generation or third generation, and the second generation or third generation are people who have studied, fairly well educated. Many of them have studied abroad and seen the outside world also. And the second and third generation, when they come back and their father's business of 30, 40 years, when they now participate, they want to bring in more professional management, and they are willing to invest in one or two important financial resources. One of them is a resource or a virtual CFO. The second profile which I am seeing is the first generation entrepreneurs. So the first generation entrepreneurs, like the Byju's example which you mentioned. So most of the first generation entrepreneurs who come, typically engineers and all of them. So they understand that finance is a very important part of succeeding. So they would like somebody to travel along with them and guide them in the process of ensuring success. So that is also happening with the first generation entrepreneurs. So that is a big shift which is happening now. Whether it is second generation, third generation, they are willing to engage, and the first generation entrepreneurs are also willing to engage it from right from day one. And the roles of CFO are what we have witnessed now. Next minute. So let me spend a few minutes on 7 guiding principles for an effective CFO. And I'll not spend time in detail and all, except probably one of the 7 principles. One of them is when somebody takes up the role of heading a finance organization of SME, first and foremost is to understand the financial health of the organization. The second is the second one, and I'd like to spend a little time on this, and this is a very common mistake. The second is taking control of the bank account. I've come across many organizations which have gone into failure where the powers of operating a bank account have been delegated to people. Whereas when it comes to a small medium enterprise, I would strongly encourage that until the organization goes to a particular size and you have good processes, controls, and very highly trustworthy people, the check signing powers or even the electronic fund transfer powers should remain only with the CFO and the CEO. You should not attempt to delegate that. And I've come across many people who get carried away with this fanciness of the title called CFO and tell this is a mundane activity of signing checks and all. The moment you delegate those in an organization where there are less number of controls and less processes, the risk of failure and misappropriation is very, very, very high. So it is very important that in small organizations, the check signing or the electronic fund transfer power should be exercised personally by the CFO himself or herself. And while exercising that role, what we will get is an idea of what are all the types of expenditure which is happening. Your understanding of business will also start improving well, and that understanding of business will help you to guide the organization. So in that context, while being a virtual CFO, never attempt to delegate this authority unless you have reached a stage of maturity where there are good internal controls in the organization, followed by the processes to support the same. Keep moving this. I'll run it first. So then is to have a good accounting function. Most organizations, SMEs, I'm sure most of you as article students will also have seen, during year accounting and all, they take it very casually. After the year end is over, in the month of May, June, they'll start doing accounting for transactions of the past. That kind of an accounting process will never make an organization succeed. Accounting should be real time. It's important to have good accounting processes right from beginning. Fourth is to have a good budgeting process. And if it's a loss-making business, you should be able to identify what are those drivers causing the losses and stop those losses from happening. The next is about budgeting. I spoke, expense approval, and this one I'll again spend a little time. The last one, and this last one is again the ensuring compliance. In fact, on compliance, and I particularly want all the younger minds who are here. Many people have this impression that compliance is a checkbox item. And compliance is mundane. Compliance is a low value item. Let me share with you my experience. And many people also have this impression that there are too many compliances will reduce over time. Mark my words, in the foreseeable future, compliances are not going to reduce. They're only going to increase. And second, as far as compliance are concerned, compliance is a cost, but it is an essential cost to be incurred. Compliance is difficult, but if you don't adhere to compliance, the non-compliance will be fatal. Once you stop complying, the risk of becoming non-existent is very high. I'll give a very, very simple example. Complying with the traffic signal, not complying with traffic signal. So when the red is there, if you try to go, the risk of a fatal accident happening is very, very high. The same is true for organizations also. Compliance, whether it is related to environment laws, relating to employee safety procedures, employee health or Factories Act operations, those compliances, the CFO should take a full responsibility for the same. Full responsibility for same. Compliances should not be seen as mundane. And on compliance sprint, my own experience is organizations which develop a good compliance culture, they are sustainable organizations in the long term. Organizations which have a DNA of taking shortcuts in compliance and all, it's just a matter of time before they slip and those organizations suffer. So it's very important that as a CFO, you should take that responsibility of compliance. So these are some very important principles of what you should do when you take up the responsibility of a virtual CFO. And then as a CFO, virtual CFO, there are several models of engagement. I'll leave a copy of the slide deck behind. I realize that I'm already past 1 o'clock. I'd like to conclude here. Probably some other occasion we can go through in detail. So thank you all for your patient listening. It was a pleasure being here today. And I know it was timing-wise, it was not a very appropriate one with all this tax filing and all. But I sincerely appreciate all of you taking time and being present here. Wish you all a very happy 2022 and stay blessed. Thank you.
Thank you, sir. You have taken us to our student day actually. Compared with member students are most beneficial now. Really appreciate your passion towards members and students. Thank you once again for accepting our request and have other friends. I request Chairman of Otherwise to come on to the dais, please. Chairman sir, I would like to ask you to give your remarks.
So, thank you, sir. In spite of your busy schedule, you're having very busy schedule as water. In spite of that, you came here, accepting the invitation, joining here, sharing your wonderful knowledge and experience. As Satish rightly mentioned, you take us again student days 2000. Thank you so much, sir, for giving a wonderful opportunity to be here. Thank you, sir.
Thank you.
Thank you, Chairman sir. I request senior member C.A. Nagaraj garu to come on to dais and please take start with Shrav. I request C.A. Sunil Pandau garu, C.A. Chandra Reddy garu to come on dais, please. Please. Nagaraj sir, senior banker and senior member. Thank you, Nagaraj sir. I request C.S. Sunil Pandau to present a bouquet to Vijay Kumar sir. Senator of Vijay. Thank you, all of you. Once again, thank you on behalf of IR branch, Varangal and Karimnagar sir. With this, we are winding up this first technical session.
Yeah. and transaction services team in E&Y Hyderabad as a senior manager. He is having more than 10 years of experience in advising clients across borders, sectors on different aspects relating to transactions, tax and regulatory matters. He is also a regular speaker in various events held by professional bodies such as IIMA, ICI, ICSI, COG, etc. This is the brief profile of the today's speaker about Nayan Sabu.
Floor is yours.
Yeah. You can hear me at the back, at the front. Okay. Thank you all for the opportunity. Just a brief question. How many of you here have worked on startups, or rather have your okay? So part A, have your own startups. How many of you? Okay. How many of you have worked on startups or have advised clients on startups? Perfect. 1, 2, 3. Okay. The back. No, we are backbenchers. No startups. Straight with companies. Okay. Fine. Now in terms of startups as well, another third question, which is a bit more, considering the OTT platforms have just shot up in the last 1.5 years. How many of you have watched Shark Tanks? Shark Tanks, yes. India Shark Tanks, overseas Shark Tanks. There are 2 Shark Tanks. You watch both? India, US one. Okay. There's one which is telecasting about the Indian one also. So yeah. If you have a chance, just watch it. Because the whole concept around that is what I will be speaking for the next few minutes, few seconds. So okay, what is a startup? Any of you? What is a startup? Anyone?
New idea.
New idea, yes. That's very important for a startup. A new idea or an idea of doing the same thing in a new way. Any other thoughts on what is a startup? I have heard of scalable business. Scalable business model, sustainable business model. Yes, definitely. But on a practical front, sustainability becomes a big challenge in startups. Because the idea is still untested to a large extent. So yes.
New idea requires a lot of support.
It requires a lot of support. Yes, support, maybe 2-3 ways of supporting, maybe funding, maybe technical support, maybe different other modes of support. Yes, that is what is needed in startups. Anything else? Sorry? Yes, very important, because we all have so many ideas, but if it's culminating into a business, it's not a startup. So idea which culminates into a business, yes, definitely. Yes, anything else? Improving the thing, the newer way of doing a particular activity or a thing or a way of business. Fair enough. Anything else, backbenchers? Sorry? Employment potential, yes. A lot of generation of employment can happen via startups. In fact, in a very different tone, it's also called generation of entrepreneurship. Just because you are developing so many people with ESOP, stock options, etc., incentivizing them that it's more of their business. So it's more entrepreneurship development also that. Okay. So just moving on. Yeah. So startup is not a concept which is generated in India. Okay, it's a concept which has been prevalent across all the economies of the world, more so in developed economies, developing economies, and underdeveloped economies, right from 1990s, because that's when people started moving more towards understanding that okay, there are different ways of doing same things, there are different startups that keep generating it. And the biggest disruption in this whole point was technology. Now, technology made a lot of people disrupt the way of doing business almost across. Now, in that, what happened is the global economy started moving towards generating more entrepreneurs than just retaining people who are at the large biggies. And that's when India slowly, steadily, right from early 2000s, started understanding the concept of a startup. Because what used to be a biggest problem in India? Let's say if I have an idea, I want to do business. I am very clear with my thoughts. I know this is the funding requirement, etc. The first person I used to approach was banks. And banks need a collateral. Startups, they are starting something, so they don't have collateral. That is when a lot of funding ideas start. Now with that funding idea, back then in 1996 when VC funds were established, the regulations had come out, etc. There was a lot of buzz around it. But what again happened with them is that their investment was only restricted to particular sectors. Then after that, the sectors slowly, steadily opened up to other sectors, but you had a minimum funding requirement. That is, you cannot fund, you need to fund, so and also reap some benefits. But the quantum of funding was very heavy. In a startup, maybe I need only a few lakhs. I don't need crores. But VC funds have been mandated to invest crores. And because of their whole team, etc., this never developed. This never moved forward. That is when the funding started further improvising. And in 2012, SEBI and the government came out with AIF regulation. This is called alternate investment funds. Now, alternate investment funds, what they did is they started bifurcating funds and allocating funds to even new ventures. That's when a lot of funding came into the startup economy as we know. Then again, there was this whole wave of in 2014 of Modi Sarkar, and there was a lot of things that were improving. There was a lot of agenda items in what Modi Sarkar's manifesto had back then. One of them was increasing entrepreneurship. And the way they increased entrepreneurship is slowly, steadily, they came out with a plan of recognizing startups in India. Now, with that startups in India, the whole game changed. And then people started understanding what a startup is technically after 2014 or 2015 when the entire economy started talking about startups. At that point in time, government also told that, okay, these startups are mainly driven by technology and they want ease of doing business. Because for them, they have an idea. If I complicate it with so many regulations, there is no business that will happen. So for them, for all of these things, they set up something called a Startup India website. And that's when the entire startups started registering, economy started moving, etc. So if you see, I'll just pause here on this slide for a bit. Okay, there are roughly around more than 45,000. In fact, now the number has crossed 50,000 as latest as December early this year. But yeah, more than 50,000 startups have been registered with DPIIT. It was of course called DIPP a few years back. It's now called DPIIT. So it's a change in the way they started organizing things. There has been immense employment generated from this. Immense entrepreneurships that got generated from this. And there are a lot of, now the whole government has also started focusing on how startups are looked at. And they've understood that, okay, we need startups also to increase the economy, increase the GDP, increase the progress of the entire economy. And that is. So this slide, of course, talks a bit more on statistics. I'll pause here for a bit. Any points, any thoughts here, anything? Okay, fine. So let me move on because I think few parts here which are mentioned, I also covered it in the later slides. So yes, and of course my slides are not bulky, so there'll hardly be few slides. So okay, so this I have just provided a snapshot of how Startup India website looks like. It's a simple website. It's just like you going to Google, you have a search bar, you have everything mentioned there. Okay, this is how the Startup India website looks like. Now, if let's say, okay, let me take you through a story. I want to start up. I have an idea, a brilliant idea, which I know will help quite a bit, at least me financially, and others maybe economy, etc. Quite a bit. Now, what do? I don't know what to do. I come to a friend, and then I ask, okay, what do I do? That is when, okay, why shouldn't I go for a startup registration, etc. So that's when I go to this website. I understand, okay, this is the startup registration. I have an option of logging in. I have an option of registering. So I need to, of course, register and only then be login. It's not the vice versa. So I register on this. I move forward. So the moment I register, now I get an option to create an account. And if you see the simplicity of the business that is being focused here, you can register with a simple Gmail that you have, simple Facebook ID that you have, simple LinkedIn that you have. So it's just simply registering on the startup website that, okay, I am this is my idea, and this is how I want to run business. You register it. After you register, you get a lot of options. And these options have a lot of things like, as an individual, whether I can register, as a business, whether I can register, as an accelerator, whether I can register. So there's this entire startup ecosystem which I'll speak about in a couple of minutes later. But yeah, whether I'm a corporate, whether I'm a government body, what is my type of registration? And after that, each option will then have a lot of things.
Not visible.
So I think it's visible here. I'll share my presentation if it that helps. Yeah. So you have a lot of different concepts. Now, what is mentioned here is basically the entire startup ecosystem. So let me do this. Let me take you one by one to each. This is an individual. So, okay, different types of registration. And I'm just spending here a minute because this also covers what a startup ecosystem is. I'm an individual. I don't have a form of business, but I have ideas, I have thoughts. Then I register as an individual. There is another option called mentor. Now, what is a mentor? Typically, I have an idea, but I have nothing. I know nothing about business. Maybe I'm just a teenager having a couple of ideas, and then I don't do anything. So for that type of thing, there are mentors who are industry specific, register on startup. There are mentors who are funding specific. There are mentors who are product specific. So there are different types of mentors. You get access to a whole lot of mentors. You can just drop them a message. It's like accessing an alumni network. Okay, then there is an accelerator. Accelerator are people, are organizations which typically help you move forward. As in, they will come up with a plan. They'll tell you, they will guide you in terms of how you move forward, how you accelerate on your path in the startup thing. Then there is institutional investors. Institutional investors are investors who invest quite a bit. They may even be angel investors investing via an organized structure. That is typically institutional investors. Then there is a corporate. Corporate is essentially the corporates who are planning to register themselves as a startup, or they may also be big corporates who are keen on helping startups or investing further in startups. By investing, I just don't need money. I just don't need money, but it may be value, it may be the way of organizing, etc. Then you have startup itself. That is, you register as a startup. So where you are clear that, okay, you don't fall under any of these, and you are clear that you have a startup idea. There's a definition of startup which I'll come in a bit. But if you are satisfying that definition, then you get straight into the startup. Then there is incubators. Incubators are the ones who are basically conceptualizing the startups. They like you have T-Hub, etc., which are all incubators. What they essentially do is they provide you with end-to-end service, whatever you want as a startup. You need a space, they have a co-working space. You need an office, they provide their registered office. You need some guidance, you have people coming in and out. You need to push yourself as a startup, that is advertise your startup, they are there. So incubators and accelerators are two very important components in this entire ecosystem, because they are the ones apart from the regular business cycle. Because in the regular business you will find individual, mentor, maybe institutional investors, corporate, etc. But incubator and accelerator are more so found in startup ecosystem. And this is very unique to them. Then there is individual investors, like let's say you, me, anyone wants to invest. And it may just be a few lakhs. Sometimes you don't need a crore. You just go there, you register. So you keep getting opportunities of way to invest once you register. And then of course, last but not the least is government body. If you are a government body, then you can register. So this is broadly startup ecosystem, Startup India's website, and how it looks like. I will pause here for a bit. Any doubt? Any thoughts? Anyone of you has seen this? Has done this practically? No one? Okay. It is very simple. As in, you may just want to try, you just want to create your own ID and keep it there. As let's say an individual, not anything else. But you get a lot of new ideas to run business, to advise, etc. So there's a lot of information over there. Sorry? Sir, I fall under an individual. I wish to be here, sir, as an individual investor. Sir.
Why not?
Yeah, I need funding.
We are not excellent.
No, I'm not. Accelerators are organizations. Are a group of people.
People cannot be.
No, not. So accelerator has so it's not a strict definition as such, but when you go for registration as accelerators, typically you need a lot of group of people or an organizational background to register yourself as accelerator. Maybe I can register as a mentor or an individual. But
Technically qualified to.
I'm technically qualified to do this,
And the
maybe.
accelerator.
Yes, and accelerator. Yes, technically qualified.
Yeah, so what are the features? You to become an accelerator.
There are no features, sir. I need a group of people because accelerator is a larger group.
What kind of?
Sorry, what kind of group? You need a group for two, three important components. One is you need the accelerators will have their own technical teams. Okay, which does evaluation of startups, makes investments, etc. Second is you need a team which is very sacrosanct in that industry itself. One is technically to invest. Second is the industry itself. Let's say if there is a startup in automobile,
Accelerator has to have the capacity to invest.
it can have the capacity. It should. It's not a should. It can. It can have a capacity to invest. It needs a technical team to support that. And also accelerators typically are a group of organizations. As in, it's an organization. Let's say for example, there's FalconX, etc. They are all accelerator funds. They're accelerator funds. But you have accelerators. They have underneath them different accelerators. So that is how it forms. So technically, I can still try for this, but I'm not too sure whether I will get that order. Because they, of course, they also have their own checks and balances before they give you accelerator statuses.
There is a definition.
There is no strict definition as we talk, but it is more like the entire startup system is now so evolved that they look at it and evaluate it. So there are people behind the website who evaluate it, and then they. So that's how. Yes. Anything else? Yeah. Now, so we move forward. Okay. So yes, we do move forward, and we move forward to what is the definition of a startup. Now I start a business. In my earlier story, I don't have any idea. Let's say I'm just doing a trading business. I buy a particular article, I sell it. Am I a startup? Yes, no. Why no? Absolutely. There's no innovation, there's nothing. I am just a starting entity, but I'm starting my business. Doesn't mean that I am a startup. For me to have a startup, of course, I need to have an idea. The idea should be a bit unique. Or let's say the idea is something that is not completely tested till date. Or there is a new way of doing things. So that is a very critical element for any startup. Okay. Now after that, what is this? So now, okay, I have an idea. Let's say I start something very, very unique out of proportion. Am I still called a startup? The answer is no. Okay, I may still be called startup from a regular parlance, but in a business technical language or in legal terms, I am still not a startup. For me to get a startup, as I was explaining a couple of slides back, I need to go and register it as a startup. Now, for me to register, what's the process? Essentially, I tell that, okay, I have an idea. I prepare a brief note on it. And then I make an application to an organization called DPIIT, which is Department for Promotion of Industries and Internal Trade. It was earlier called DIT. So I approach them saying that, okay, I have a startup idea and I wish to register myself as a startup. Now, for me to register myself as a startup, as we were discussing, one is the idea. Second is, now even if I have an idea, today the business structure in India has evolved. Earlier it was run more like a sole proprietor. Simple. I run the business ends with me, or maybe goes to the next generation via me in my will. Then came up partnerships. Where two or more people started combining. There was also the concept of a company which was brought in from the West. The company structure started evolving. There are private limited, public limited, different types of companies. And there is also limited liability. So for you to register as a startup, the first prerequisite is you need to have a business structure in place. This firm, LLP, or a company. The partnership firm, LLP or a company. Then I shouldn't be more than 10 years old, because if I am more than 10 years old, it is deemed that I have approached some matured stage in my business career, business life, which cannot be the case. So it has to be a startup, which is a new name. Turnover should not exceed 100 crores, because the moment I exceed turnover of 100 crores, then typically I am someone who is a biggie, any business. So I shouldn't do that. Now apart from these three basic things, the fourth thing that was just discussed, which makes me a startup, is essentially I need to have an innovative process, product, idea, etc. May or may not be patented. I think getting a patent done or not done is a secondary process, or is a different conversation. But yeah, I need to have this. And the entity should not be something that I split from, let's say, a larger entity. I had an entity which had two businesses. One business suddenly got innovation. I moved it away into another business. That is not how startups get created. Startup is something that you are starting on your own. It's starting. It's incubating. It's incepting from there. After I have all these four criteria, I go and approach DPIIT via the Startup India website, which I was talking about. I go there, I make an application saying that I qualify this, and this is what my business is. And thereafter, I get a startup registration. If I get that registration, then it is called startup. Okay, so just taking you back 3-4 slides. If you see here, this 41,000 odd startups that I'm saying are the ones which have qualified all those conditions which I was speaking about. They are not just the regular startups. They are startups which have been registered, where there is a certificate of registration granted by DPIIT to them. That is how they've qualified. And this number, mind you, has crossed almost mind-boggling 50,000 million. So there are a lots of startups which have already come. Okay. Now, our favorite subject, tax. Maybe audit for few, but yeah, tax as a component. Now, so just taking a step back. Now I qualify for all of this. I register myself as eligible startup. Then what? What's the benefit that I am getting? Any thoughts on what are the benefits? Tax benefits, of course, yes, because that was the next slide. Definitely, yes, there are tax benefits. But apart from tax benefits, what?
Investments.
I get linked to investors. Yes. Sorry?
Fund mobilization.
There is fund mobilization. There's fund generation. For the whole thing, yes. Sorry? Product recognition, yes, definitely. If you are a startup, you have chance of getting into the unicorn leagues. Yes, recognition. Anything else?
Patent, product need to patent.
Product patent need not depend on startup, but yeah, startups have some incentivized method of getting a patent registered. You can, as I was explaining in that earlier slides, when I was talking about the website, via that website, I can also go for patent registration. That's the advantage. If I'm not, then I have to go through the regular legal process. But via that, I have lower fee for my patent registration, etc. Once I'm an eligible startup. Then, and
Incentives from government.
there are incentives from government. Yes. So government incentivizes startups in two ways. One is they have created something called as fund of funds. Where it's I think 2,500 crores odd fund which is created by the government, which funds into the funds which invest into startups. So that as I was explaining, there is this alternate investment fund. There is a category 1 alternate investment fund, which has an exclusive subcategory called angel funds. So these angel funds are funded by funds of fund also, depending on this. So that's where government incentivizes them from a funding perspective. A. Second is, if you if we go through the website again, there you have opportunities to go to the government for specific incentives of your staff, which are available, because generally government gives incentives for something called as mega projects, which is let's say more than 100 crores of investment, more than 1,000 employees being employed and things like that. For startups, to go to that scale, then you are no longer a startup. So till the time you are a startup, there are certain recognitions or incentives which government gives you when you ask for it. Let's say you say, okay, I will generate employment of 100 people in the next 10 years. Government will say, okay, generate, I will match something, I'll pay you something, things like that. Of course, in that incentives, the largest category is income taxes that you have for startups. Okay. So yes, income tax incentives. Every one of you familiar with, okay, forget ATIAC, have heard about angel tax. What is angel tax? Anyone? Angel tax. Which section is angel tax? Under income tax Act. Anyone? What is angel tax? Anyone? Angel tax? Yes. Angel tax? No. What is angel tax? Which section of income tax? 56? Sorry, 80?
80 series income related.
80 C.
80 series income related.
No, that's not angel tax. That's not angel tax. 56, yes. 2. 56 2. There is another subsection for another clause. No, not it. So okay, it is 56 2 7B. VIIB. Okay, 7. Why was this introduced? I have of course mentioned 56 to 7B here. Okay. Why was this introduced? It is a very rather okay. I'm politically agnostic, let me be very clear, but yeah, it's driven by some political agenda which happened in Andhra Pradesh. Whose case made 56 to 7B come into picture? Anyone? You heard about Jagati Publications?
Yes.
This section is the result of Jagati Publications. Jagati Publications, Bharti Cements, etc. Of course, politically, you know which alliance it is. But yeah. So what happened then? What was the mischief that happened then? Under income tax, there is a common principle. All capital items are not taxed unless specified. All revenue items are taxed unless not specified. Correct? Now, when an investment comes into a company, it is capital in nature, basic capital in nature. From your accounting, tax, legal, all perspectives, it is capital in nature. Now, when that money came in, earlier there was no principle of doing a valuation for it. And in fact, developed nations today like Singapore, US, etc., still don't have a concept of valuation for a particular investment that comes in. So what used to happen is a new company is formed, 1 lakh capital. What will be the value of it? Fair value of it, even if I am to 1 lakh. There were cases where the value was ascribed as 1,000 crores, and every share that you had to infuse came in with one share, face value 10 rupees, securities premium more than crore rupees. Okay, so that was happening, and that entire money was not taxed, because what I used to do is it's very simple. I have a company, I put in the money, 10 rupees face value. I had to, let's say I have to pay someone something. I put in 1 crore as securities premium. Do a share transfer. Finish. No one is taxed. I am not taxed. I'll book loss in fact. I'll book a capital loss which I'll carry forward or set up, whatever. But this entire infusion that was happening was going unnoticed. Till 2012. Mind you, from 1961 till 2012. Rather 1956, because Companies Act came in 1956, the newer version. Before that it was earlier version. So from then on, no one was observing this. Government finally observed this. Told, okay, I will introduce a section which taxes this. So what it says is, if your company's value is, let's say, 1 lakh rupees, or I'll go by per share 10 rupees face value. You issue anything at 10 rupees, I have no problem. 56,270 doesn't matter. You issue anything at premium, let's say I, instead of 10, I say 30 rupees is the value per share. Justify it with a valuation. This valuation report, of course, has gone lots of time. There will be who should be the valuer, there will be changes, what should be the methodology, etc. So it simply says book value or discounted cash flow by merchant bank, CAT1 merchant bank. Earlier it was also a CA who could do it, but now it's strictly merchant banker for discounted cash flow method. Now that section came. Okay, how is this section now relevant to startups? Let us understand this. I'm a startup, new company, director, but I have an idea that can change your life. Now for that idea, I need to get paid premium, right? Because let's say if someone is investing, I have started a company, I only have 1 lakh in my pocket, so I only started with that. But let's say if someone who wants to invest 1 crore, the moment he invests, he will practically become 99% owner. And my idea is to sustain for a longer time, and I need to spend more time on it. So I need to give him something which is not 99%. How do I justify it? I need a valuation report, discounted cash. It's only an idea. How can I give a valuation report? An idea, I don't know. Tomorrow, as per my projection, it can even be 1,000 crores, or it can end up only with, let's say, a loss. Nothing else. So this section is now hurting startups. Okay, now to address this section, what they did is, to address this section, what was done is essentially DPIIT along with income tax came up with a point of view that okay, we will not tax this so long as it doesn't exceed 25 crores. So up to 25 crores, once you are an eligible startup, once you are an eligible startup, then up to 25 crores, no one is going to question you on the valuation. The day you cross 25 crores, everyone will. There are exclusions in this 25 crores, and there are 2 exclusions. One is foreign investment. So 5627B, when it was introduced itself, there is an exclusion of foreign investments because as per FEMA, if you are getting investment into India, you need to get it at minimum fair value. Anything above fair value is fine from a FEMA perspective. Now, if that same thing I tax in income tax, I am going against. FEMA is acting against income tax, which is why tactically 5627B is restricted only to resident investments. Second is there is an exclusion of AIFs here. So when an alternate investment fund is investing, it is deemed that they are adhering to SEBI's principles. And SEBI, from an investor protection perspective, has ensured that even if they are issuing shares at premium, not a problem. So these 2 exclusions still continue while I am calculating 25 crores. Which means, let's say if I get 10 crores from foreign investment, from a foreign investor, I still have 25 crores buffer remaining. That is the exception for a startup. That is the whole story of angel tax. Okay, so next time anyone asks you angel tax, it is 5627B. And this is the exception which is granted to them. Now, any doubts?
So both of companies was it 25 crores? Why do we need to start? We can go for venture capital.
It can go, but it can. That's not a problem.
Then no Indian tax.
No Indian tax. But for me to go up to 25 crores, I need to do some investments. Without that, I can't. So it's a journey till you hit venture capital and private equity. After you hit venture capital and private equity, you are in a different league altogether. You are no longer.
Capital can also invest at least in this.
Can. There are venture capital. So venture capital is now called alternate investment fund. Or, common terms. In alternate investment funds also you have category 1, which talks about angel funds, angel investment. So that is also. They can, and they do. It's not that they can; they generally do also. Yes. Okay, so that was on 5627B. Carry forward of losses. Any thoughts? Anyone has heard section 79 of Income Tax Act? Correct. Absolutely. if there is a change in 50% shareholding, rather more than 49% change in shareholding, you lose your carry forward of losses. Rather, you lose the ability to carry forward and set off those losses. Correct? Now, in a startup situation, I have an idea, but for me to have that idea, I need to develop it, advertise it. Only then will I be able to sell it. Correct? Not till the time I reach my stage, I must have already burnt a lot of cash. I must have burnt a lot of money. So I will always have some or the other losses which are remaining. And now in a startup, as a founder, I am continuously getting rounds of investors. That is one investment done, the next investment start. The next investment done, the next investment start. That is how I will be able to survive. Or rather service. Okay, now if there is a change of more than 51%, or rather a change of more than 49% shareholding, then I lose all the losses, all the earlier years losses which are there. So to protect the startups from losing such losses, there is an exception in 79 which is created. What it says is, so long as a startup investor is only getting primary investment. Now what do I mean by primary? There is no sale of shares. There is only infusion of funds into the company over a period and continuously infusion. So long as there is no change in shareholding, no transfers, etc., losses can be carried forward even if the shareholding change beyond 51. Okay. Now the day there is a change in shareholding by way of a transfer, you go back to the regular provisions of 70. Essentially, they are saying startups must get funds into the company, grow it to a large extent. After it crosses the level of startup, then you start recognizing 70. That is how they are incentivized. That's the second tax advantage of startup. The third tax advantage is very similar to how you have 80IA, 80IAB, 80IB, etc., which are more focused on SEZ, industrial development, particular township development, etc. Now they have introduced a section called 80IAC. Okay, as per 80IAC, for a period of 3 years out of 7 years, or out of 10 years. Okay, this got amended in 2019. Earlier it was 7 years. For a period of 3 years out of any 10 years of your existence, choose. You get exemption for those 3 consecutive years. For all the income tax on the income that you are earning from the start. Okay, that is what is mentioned. So essentially, it's a tax holiday for you for a particular period of 3 years out of any 10 years that you decide. Because startups, anyway, starting first 2-3 years may be in losses. Typically, after 4th or 5th year is when they start breaking, and 6th, 7th year is when they see profits. So which is why 6, 7, 8 years or 7, 8, 9 years are. And there are compliances which startup has to do for taking this. As in, there is another. Once you've got a startup recognition, you again make an application in Form 1 for this. There's a form called Form 1. Then there's Form 2 for income tax. And there is, of course, self-declaration which the startup gives every year. So this is broadly on tax. So okay, apart from this, just one last point. Apart from this, there are certain other benefits which are given to startups from a regulation standpoint, which is more on Companies Act and all. One is from a taxation perspective, ESOP tax is deferred for a startup. Let's say ESOP, how is ESOP taxed? Today you get ESOP of a company, you are taxed on day 1. That is the day you exercise. Okay, you get granted, vested, I'm presuming all of that is done. But the day you exercise, you get taxed on the fair value of the share of that option which you exercise. So startup that is generally taxed on that date. But for a startup, it says you can defer it for 4 years from that date or the date of sale of that share, whichever is early. So they've given you an additional window of 4 years. Your taxation is fixed. The amount of tax is fixed. Then that you defer it for a period where you are able to sell it. Earn money, pay tax. That's the simple logic. Then again, from an ESOP perspective, etc., startups do not have specific ESOP limits as to how much ESOPs can be granted, how much SWET can be granted. Under Companies Act, there is 10% ESOP limit for a particular type of director, type of employee, etc. And also you have sweat equity related restrictions. Those restrictions are relaxed for a startup. So that is broadly the incentives that you get in startup. I will pause here for a bit because after this I will straight get into funding related points, which is more practical funding related points, and then opportunities where chartered accountants and all of us can focus. So any doubts till here? Any doubts? Then should I move?
I have one question.
Yes, sir, please.
Go back to the section 79 which you spoke about.
Yes.
Now, you said there could be other funding sources, not to dilute the equity so that you do not lose the status of a startup.
No. So what I am saying is, you can have equity funding. You can have equity or CCPS funding, whatever it is. Section 79 defines it both. So equity funding I can have for as well, but as a founder, let's say first round I started with 100%. Second round, someone else invested for 20%, I become 8. Third round, someone else invested for, let's say, 40%, I became 40. 40. That day I crossed 51%. In a regular situation, I would have triggered 79. But in a startup situation, because I have never sold any shares, I have got money only coming into the company, 79 protects. Let's say in a situation where I have 79 triggered, let's say 40% is here. I'm here till here, 79 is protected for me. The next round of investment, I decide to sell, let's say 10%. Sell 10%, get 10%, get 20%. The day I decide to sell even one single share, I fall back to the regular 70. I don't get that back. It's got nothing to do with the funding option. It's got voting percentage that I will ultimately have. Or other shares which carry voting percentage.
So the legal investor would like to have a voting percentage as well.
Absolutely.
Okay, so what is the alternate option? Are you seeing anything like preferential shares being?
Yes. So typically 79 in a regular situation, forget startup, even in a regular situation, is led by CCDs and CCDs. Startup to Indians shall be minimum 50%. Nothing else. No.
Carry forward benefit, how long they can hold?
So typically you will carry forward benefits, so it depends on the type of loss. Let's say if it is business loss, you can carry it forward for 8 years.
Once you transfer, you're saying, even though they want to transfer, still enter the benefit of carry.
So long as there is ownership transfer by way of infusion into the company and I am not transferring any share, I can enjoy this benefit till perpetuity.
But
Yes.
one more thing is this 25 crore limit. You are saying like till that once you cross that limit, so the 50 criteria is not necessary.
I don't get 56 to 70.
Even this say like the 10 years, say for example, this 10-year period.
For this.
Say 8th or 9th year, if I cross 25 crores, I lose the benefit of.
No. So there are 3 parts. The moment you cross any of these, that is turnover 100 crores or 10 years, you lose startup registration.
Okay.
The moment I lose startup registration, all these 3 benefits are automatically gone prospective, not retrospective. For each of these 3 benefits, there are certain requirements. First is I have to be a startup. Then let's say if I am satisfying this, so long as I am satisfying this, no one is questioning. The day let's say I cross 26 crores, I get into 26 crores. Then above 25 crores, whatever investment comes has to satisfy the 56 crores.
In that case, like still can avail the.
You can still avail this benefit. Yes. This benefit, all 3 are mutually exclusive and positive. They don't depend on each other. Except for a criteria that it has to be a recognized startup. That's the only criteria for all. Yes. Yes. Any.
Just one follow-up question on the CCD. I understand if it is a limited company, CCDs and CCDs can be used. How about an LLP?
So in an LLP, sir, so technically see in an LLP, for me section 79 is not applicable. In an LLP, as we know. So long as it is not applicable, in LLP the situation is when you retire. Admissions are not a problem. Retirement is a problem. When I'm retiring, I'll retire completely. So it's 100 to 0 straight in an LLP. So 79 doesn't apply. And in an LLP, I can dilute up to, I can still be a partner. So unless I'm retiring, there is another section called 73 or 74 which gets taken. Otherwise,
Yes. You spoke about
Yeah, please. Yes, sir. Please.
So you spoke about the registration with DPIA. Is there a provision for de-recognition at DPIA once they become non?
They have powers.
Yeah.
They have powers. So typically you get automatically de-recognized if you do this. Turnover exceed 1 year. In that 1 year, 100 crores if it exceeds or ages more than 10 years. Even if you are recognized by DPIIT, you become de-recognized.
So you need to apply or it is automatic?
It's a deemed de-recognition. There is deemed de-recognition. Second is if DPIIT sees that there is something wrong in your application, etc., or you did something fraudulent after this and all of this, they have the power to de-recognize.
Would they also depend on tax returns from
Who calls?
DPIA?
DPIIT typically works in consonance with CBDT. They do not generally call for it unless there is an exception. Because with DPIIT, there is generally a yearly declaration that you file that I am complying with.
There are business idea. Is there a business idea which merchant bankers and investment bankers are quoted valuation of more than 25 crores? So they invested money. So do they need to pay angel tax?
No. So see, up to yeah. So I am assuming in your case it is a recognized startup, and then there is a round of investment that happens.
It's not yet implemented, but the idea is very good. So investors are ready to invest. So the valuation will be more than 25 crores.
The valuation can be more than 25 crores. The amount is a point. You can have a valuation of even 100 crores. You can dilute up to 25% and still fit under this.
When
No
investor
problem.
want to invest more like 50 crores, then do you need to pay tax? Angel
So long as you are able to back it up with a valuation report, you don't pay tax. DCF merchant banker if you have. DCF from a merchant banker. And if a merchant banker himself is giving you that valuation, I'm presuming there will be some science to it.
There is a definite convertible division. Can it also be treated as a?
No, it will not be treated as share capital unless it becomes a share. Because 79 says two conditions. 25 crores means no, it's only paid up share capital and say share fees.
Even though there is a different term.
You can have 100 crores of debenture, no problem, you are still eligible. Because on debentures, 5627B itself doesn't apply. It applies only for shares. By shares, I mean preference shares. Yes, anything else? On this, anything else? Any further? Okay. So moving on. Now, essentially, you will all hear that okay, this startup got funded with so much amount. In fact, we are discussing the example of how much startup is getting funded, what investment bankers are valuing. Now, what are the stages of a startup? And this is common across. It need not just be restricted to startup. It's common across every type of business that I am talking about. One is self-funding and friends and relatives. Typically, I have an idea. I fund it myself first. Then I get funding from my friends, family members, etc. After this, you will start getting angel investor funds. Typically, till this stage, which is angel funding and seed funding, you are startup. The moment you cross this and move into VCs, AIFs, and PE, typically you are no longer a startup because you've either crossed 100 crores threshold or you've crossed 25 crores of investment, etc. That's the general situation. Maybe there are exceptions to it, but that's the general situation. So you start with self-funding, friends and relatives, then comes angel funding. Angel funding, what is angel funding? Angel funding is someone who is investing in you like an angel. Like an angel is coming and blessing you. He's the one who will bring in value in terms of money, maybe. Second is value in terms of developing you or your startup. Let's say for very simple example, Azim Premji, he knows what to do in and out of information technology. He makes investment in a particular small firm, let's say a startup. He is typically denoted as an angel because he is bringing in value, not just in terms of money, but in terms of different business aspects, etc. So that's very layman concept of angel. There are angels can also be a network, and the network is providing you benefit. You will hear a lot of networks like Hyderabad Angels, Indian Angel Network, Mumbai Angels. Almost every city has angels. There are again regional angels like Agarwal Angels, Marwari Angels, and things like that. So there are a lot of things like that. So those all people come as angels. Typically, they come in for a period of, let's say, minimum 2-3 years because they want to grow with you. They are investing in the person and in the idea. They are co-taking that risk. The process is covered exactly in the next slide. I will come to it. But yeah, just before that, just broadly in the overlay. Then there is banks and financial institutions. Now, typically, banks and financial institutions are not very common in startups. The reason for it being uncommon in startups are two. One is bankers and financial institutions need some type of collaterals before they give you any funds. Maybe a small working capital fund here and there is fine, but not term loans, etc. So that is why you don't find bankers here. The second important reason is bankers are not equity investors. They don't take risk with you. They'll be like, I give you $100, pay me $10 interest. Finish. How you pay me, when you pay me, I don't know. I'll mortgage it with whatever you are. So it's more like a restrictive investment and a compulsory mandatory obligation for you to make. So because of these two reasons, you don't find a lot of banks and financial institutions prevalent in startups. While of course, once you've grown to a stage, maybe you get a lot of funding because you have adequate collaterals, etc., or adequate cash flows to match the interest component of it. Then comes VCs, AIFs, and private equity, which is basically the large funds. At this stage, it is presumed, or most maximum cases here are the cases where you've crossed 100 crores turnover or you've crossed 25 crores threshold of investment. That's when typically you go to VCs, AIFs, and PEs. The last is of course public market, which is the IPO. And there have been a lot of IPOs that we are seeing in the last 2-3 months, Nykaa, Paytm, etc. All of these were initially started as not technically registered startups, but yeah, they were all startups because back then the registration formation itself wasn't there as we know. But yeah, they've all gone through this whole cycle of fundraising. They've had angel investors, they've had banks, they've had VCs, AIFs, and finally they've got for an IPO. So that's broadly on how the funding cycle looks. What is the process of doing this? So addressing your precise question. So if I'm helping a startup, which I'll of course cover in the next slide also because there's so many opportunities here. If I am searching, so first is I search for an investor, or rather investor searches for me, either of the cases. After that is done, there is a preliminary evaluation both from a startup front that okay, whether is this investor the right investor, and from the investor front, whether this is the startup the right startup for me to make investment, or this is where I can add value or multiply my money. Whatever. All of us, that's the opportunity. Then there is execution of term sheet. The term sheet is basically terms. Okay, you invest this much, I give you this much. 1, 2, 3, 4 other terms based on which you invest, etc. Then typically there is a due diligence process that is run by the investor on start. Startups also can have their own diligence report ready and given to them. Then finalizations of what are the representations, warranties that I am going to give as a startup and I am going to take as an investor. What are the conditions, precedent, subsequent, etc. And then basically finalizing of the documents which are to be executed. Then execution of agreements. What are these agreements? These agreements are confidentiality and non-disclosure agreements because startup, as we were all talking, is an idea. So idea needs to be protected. There is share subscription agreement, non-compete agreement, IP assignment agreement, and shareholders. So there can be a mix of these or even other agreements. So these are generally prevalent. Share subscription agreement is where the investor is going to invest into the startup. If it is going to acquire shares, then it is share transfer. Non-compete because let's say I invest in the startup. The idea is also incepted by a person, right? That person leaves the organization gone. My entire money is gone. So which is why a non-compete or a non-solicitation agreement. And then the IP assignment agreement. That is, if the IP is in my individual, assign it to the company because I'm investing in the company. Finally, the shareholders agreement. And okay, this is the overall agreement between all of us. There will be rounds of shareholders, and I have all the agreements. After that, I execute the agreement. I get the funding. I do a closing. This is generally the process. This process can range anywhere around 2 to 6 months, also, or maybe more. But the general trend is around 2 to 3 months to generally see. But yeah, if there is some observation, there is some pickup, etc., This can even stretch beyond 3 months, 6 months.
So we term it as an angel investment. The whole process makes both of them interacted and know each other.
Yes.
Term
So-
is different, but still we know.
Correct. So sir, angel investment also happens in two types. One is more like an individual angel investment. You know someone, you invest. That is individual angel investment. Second is institutional angel investment. Like let's say I become a part of Hyderabad. I invest, I tell them I commit a fund of 10 lakhs. They decide to invest in a startup. They may invest 2 lakhs out of that 10 lakhs. 5 lakhs they may invest in other startups. So it's a pool of funds which then makes the investment. That is also possible. This, both the places, this is typically for. As in, if the investor is individual investor, you may decide to skip diligence, you may decide to keep the agreements loose, etc. Or you may decide not to execute the term sheet because it may just be an oral term sheet. But yeah, generally this is how the cycle moves. A general observation of this. So yes, that was broadly, my gyan to you as we talk. Now coming to professional opportunities here, which all of us can do, and we are doing, of course, quite a few places. If you see this entire, okay, 3 parts. So the reason why I have broken it up at all places. Let me take you back through the whole slides. Registration assistance to a startup is something that we can do because in the application that you make to DPIIT, there is sometimes also financial projections that are put across. Now, a person who's, let's say, a pure doctor or a pure engineer who is not so sacrosanct with the accounting way or with how to do funds, you can help them in entire registration process as a chartered accountant. And this is generally done by chartered accountants. There are a group of there are a lot of chartered accountants who exclusively work on startups and help people in the registration because they know what moves through DPIIT, what doesn't move through DPIIT. Then explaining them what the definition of startup is, because half of them don't know the definition of startup. So explaining them that how the definition of startup moves, how you should register. This whole process guidance can be given by us because we know the law. CBDT, DP, IIT are very closely bodies. The entire benefits that they can get, advising them, assisting them in claiming all these benefits, right from filing Form 1, Form 2 and other forms, till filing their returns of income and time, is what we can have. Okay, now before I get into funding, startup is ready. You can help them right from core accounting till audit, till liaising, everything. So there is a lot of opportunities for us to do everything end to end for them. Just they focus on their business while the entire finance function is practically managed by us. That is another opportunity. Now, when it comes to funding, at each stage of funding, this entire process, okay, preliminary evaluation, valuation can be done by you as chartered accountant because we know what numbers are, we know what language the valuation speaks, how to benchmark it. Preparing a brief term sheet because here you don't need a lawyer to prepare a term sheet. Chartered accountant can. Doing the entire diligence. Diligence today is performed practically by chartered accountants, which is called financial and tax diligence. Okay, assisting the startup or the investor both in terms of finalizing the warranties, reps, what to be given, what not to be given, how much to be given. The entire negotiation process, in fact, the entire negotiation process with the investor, if you are acting from startup perspective, or with the startup, if you are acting from investor perspective, can be done by chartered accountants. So there are big investment bankers who generally take up fund mandates of more than $100 million to begin with. Lower than that, the entire space is open for all to have these conversations. And helping them in entire funding, the compliance process of it can be done by chartered accountants. Of course, execution of agreements and these agreements, I will still suggest a lawyer can do. You will have formats, but every case is a unique case in startup. So which is why a standard format may not work. You will still need lawyers' assistance, but apart from that, you can work very closely with lawyers to run the whole process. These are broadly the opportunities, and so many more. You can start your own startup, get yourself recognized, get yourself registered, achieve all those things. There are different ways in which you can run the profession. All those unique ideas, etc., can make you eligible to become a startup in yourself. So that was broadly on startups. And thank you. Any doubts? Anything? I hope I was clear. I hope I didn't confuse you. Yes. Thank you. Yes, I will share this presentation. It also has my contact details, me and my colleagues, so you can anytime connect back.
Thank you, Naren. It's a wonderful session and useful for everyone.
Thank you so much.
And I request Srinivasa come to the dais. We are okay to speaking of the session.
Thank you so much.
Thank you, sir.
Sure. Yeah. Okay. In fact, sir had also mentioned. Sorry, I missed mentioning this. So my practical experience in terms of how I was helping a couple of startups, or I was still helping them. There is a startup which is in insurance space, focused on life insurance on a technology platform where your entire evaluation of health happens on the app itself. Okay, so this is a startup where I'm currently helping them. So how am I helping them? I've prepared how the business plan should look like in terms of the numbers, because he only knows how many people to employ and he only knows how to do business. So helping him purely from the entire application, the entire preparation of something called as a information memorandum, which is basically a profile along with the business plan, and then pitching it with the investors. Now having conversation with the investors yet to close the deal. This is the latest one that I am working on. While I've closed more than 2-3 rounds of startups at different places. In those, I majorly assist from the investor side. That is, when a startup prepares a pitch, comes to us. What are you looking at? Purely helping the investor out from a financial and a compliance side completely. That is, let's say if the startup says my value is say, so okay, there was a deal. There was a unique deal which we closed only in May, just before during the lockdown. So the startup is a startup in furniture. It's an interior design. It's an architecture startup. Yeah, I can't name it for confidentiality. There was an investor. Individual angel investor. The individual angel investor told a year back, okay, boss, I will invest 3.5 crores in you. How much percentage will you give? The simple answer was 10%. Okay. Now to justify that 10%, the valuation was reworked. The startup came up with a valuation report of 35 crores pre-month. So technically, I don't even get 10%. I get only say 9%, which the investor was completely unaware of, because investor just had funds and it's an individual angel investor, not so sacrosanct with investment terms and all. He invested out of your way. Now, the moment we stepped in, we had a lot of conversation on that in terms of how the valuation is 35. We'll just justify it for whatever reason. Justification is simple, long spread Excel sheet which I prepare for the startup. So I know where the glitches are, where the glitches are not, etc. And then we benchmark them. Fortunately, the startup was making profits. So for me to benchmark them was very easy. Because I have international standards, etc. Now I did all of those studies, etc. The valuation came only 6 crores. Okay, pre-money valuation not more than 6 crores. So 35 crores versus 6 crores. How do you bridge this gap? Lot of conversations. We had tussles, we had fight, etc. And the investor, of course, was very innocent, so he had no rights. As it is 10% will get diluted in the next round. He has no rights to sell it at a particular value. The founders were not bound by any specific conditions from his end. So we stepped in. We changed the whole modalities of the deal. Ultimately, the deal got closed with 6 crores for 30%, which is essentially a pre-money valuation of 14 crores. More negotiated value, etc. And the investor today has a vote seat, has all the possible rights on this plan against the startup. So generally, typically, of course, I prefer more from an investor side because we can be more dominant in the conversation. But yeah, helping the startups as well on the startup side. So those are broadly 2-3 practical experiences on both ends. And of course, there are others in fact still. Yes. All right, okay. Thank you so much.
Thank you, sir.
Thank you, Nayan, for the wonderful presentation.
Thank you so much.
Yeah. Friends, we are starting our next technical session. Today's last technical session, export and import intricacies and FEMA. I request today's speaker, CSG Murali sir, to come on the stage. Welcome, Murali sir. I request CA Uppalpati Saran Kumar to present the health bucket to today's speaker. Thank you, sir. Before handing over the session to speaker, it's my proud privilege to introduce CA Murali Krishna Gottipati. Sir is a fellow member of the Institute of Chartered Accountants of India and Institute of Company Secretaries of India. He has overall more than 50 years of experience in practicing in the areas of FEMA, FCRA, SEBI, ODI, ECB, and compounding proceedings, FIPB matters, company law matters, NBFC, public issues, takeover courts, private equity matters, conducting due diligence, valuation, and capital market issues, and also presented papers on the state topics. He is actively engaged in the activities of ICA and ICSA and regular faculty to the professional institutes and corporates, government bodies, and undertaken training programs and presented papers on various topics on the above cited subjects. With this small introduction, I am presenting Murali Krishna sir. Sir, please take forward session. Yes.
Good afternoon, friends. So today's topic with respect to FEMA has been selected in such a way. Generally, we are seeing of late the concept of enforcement from the regulators, especially RBI or Enforcement Directorate, who are of late coming with respect to various FEMA non-compliances. We thought of making this as a comprehensive review. So basically, what we are trying to see is why companies or organizations which are into exports or imports, why they are coming into the RBI radar or AD radar or Enforcement Directorate radar. For the simple reason, most of the time we may surprise to see very small issues are leading into a bigger one. Okay. So generally to say, FEMA, when it may be applicable, when there are transactions between residents and non-residents. Or if the transactions are happening between residents, but the transaction is connected to the cross-border. Or it is happening between two non-residents, but connected to the India. Either way, the FEMA may trigger into the action. So imports, typically, if you see, India is predominantly still driven by the imports. Though, we think like, we need to go for the exports. But as such, still we are struggling hard to meet our requirements. So largely there is a import as the predominant activity. So if we see cross-border trade, be it import or exports, there are multiple regulatory authorities who will come into picture. One is about the DGFT, that is Director General of Foreign Trade, who regulates or administers the foreign trade policy as given in the Foreign Trade Development Regulation Act. Other one is Customs Authority, who normally clear the goods in a cross-border transaction. GST authorities, of course, earlier we used to see excise and sales tax, but after introduction of GST authorities also play a bigger role, both in terms of permitting the import, clearing the goods with the GST payment, all those stuff, and other dealers, because the money has to go through a specified bank as the company deals with. So other dealer plays the vital role in terms of the remittances. Income tax authorities, because many times the transaction may be subject to taxation in India, so there is a TDS deduction or a non-deduction and all those stuff. So income tax authorities also play a bigger role, and there are a few other laws such as R&D cess, which is administered under the R&D cess Act 1986, which talks about the payment of cess for the import of drawings and designs. So if you look at these things, apart from what we have seen in nature, but the other laws in terms of RBI has given a master direction, which is compilation of the all circulars issued from time to time. So this master direction, which was issued since January 1st, 2016, that was the year earlier master circular used to be there. Later it has become master direction. And of course, the latest RBI master direction on imports is updated up to 7th December 2021. Like they are trying to update with all the amendments that are coming forth. And other RBI master direction is with respect to ECB and credit rates, because imports, maybe if we have elongated period of credit, it is tantamounting to availing the loan kind of scenario. So that way ECB credit related master direction, that is direction number 5 of 1819, is also applicable. And foreign exchange management current account transaction goods, because whenever we import goods, when the Indian party want to make the payment, it has to be seen whether it is falling under current account transaction. If so, are there any limits? Because there are 3 schedules, schedule 1, 2, 3. Schedule 1 talks about transactions which are prohibited for any import. And schedule 2 talks about transactions where RBI approval is required. If the amount is, central government approval is required, if the transactions are of specific nature. And schedule 3 talks about transactions where RBI approval is required if there is a threshold amount which is being breached. So we need to see all the 3 to ensure that the imports are within the parameters of the guidelines that are given. So what is the normal time for imports? Because generally whenever we do audit, certain things what we are not trying to look at it is whether a CA, while he is certifying the financials, do they require or obliged to disclose any non-compliance under FEMA? That is always a bigger question. Always we feel there is no specified requirement. But when we look at the concept of any legal compliance, even this non-compliance, if there is any, has to be reported If not as a qualified opinion, at least as a modified opinion. Okay, or matters of substantial interest. Okay, so that way we need to check is there any non-compliance under imports. If so, we need to see and report it in appropriate form. So any import into India, it has to be paid within 6 months of its import. It's a normal credit period. Any seller or exporter is supposed to give. But if suppose it goes beyond 6 months, then we need to see this as a trade credit requirement. When we say trade credit, there are again two kind of credits. One is buyer credit and other one is seller's credit. Okay. So here it is a seller credit, that is the seller is giving a credit period in excess of the normal credit period of 6 months. Okay. So if there are some reasons why the imports may not be paid within 6 months, like suppose if there is any performance guarantee, like if the machine has to perform at a certain parameters, until it is proved, maybe the payment will not be made. That's a different story. But if it is simplicity of supply, where no performance conditions are attached, goods are received, minimum quality standards are checked, then payment is supposed to be made. Okay, that's one way. It may be due to some disputes, like quality. Of course, whatever material has been supplied may not be up to the mark. So obviously, the buyer is not ready to make the payment. That is also one way of going beyond 6 months period. Or it could be the importer is not adequately having liquidity where they can pay the amount within 6 months. That could be a different story. But in all, always it is normal import period is 6 months. This is what we need to be very clear. Suppose if someone is giving beyond 6 months, then we need to check what else we need to comply. That is, we call it a deferred payment. Right? Anything goes beyond 6 months, it's a deferred payment. And under ECB regulation, there is something called trade credit. So one has to comply the trade credit regulations. So sometimes, basically, if at all there is an import related advance is involved, there is a possibility, like some 10% we need to make payment on order, some percent has to be paid on making the product ready, or balance amount upon dispatch, something like that. There could be conditions. So if so, basically one has to check that whether we are making payment directly from bank to the seller, or we are making the payment via AD bank. That is through LC. Normally, letter of credit is one of the documented credit through which one can be paid. And suppose if there is any delay beyond 6 months, whether the importer can make the payment of interest, of course yes, but there are guidelines. It cannot be at whatever interest rate the parties mutually agree. It can be paid only subject to the boundary conditions given in the law. Normally, it should not be more than LIBOR 6 months average LIBOR plus 300 BPS, that is up to 3%. So if LIBOR is say 1.5%, then plus up to maximum another 3% we can add. Okay, we can't pay in whatever fashion we want to have it. And if suppose any advance payment is made, the advance payment is again one important thing that we need to check is when goods have to be imported. Just because we can't make the payment and sit silent. No, we need to ensure that the goods also are imported subject to the commercial conditions that are given in the whatever document we enter, that is PO agreement or whatever the case may be. Otherwise, there is every potential, this can go into the ED radar. If somebody simply make the advance payment and sit silent, it means there is a possibility that the money is laundered. The money is diverted in the form of the import payment. But generally, whenever somebody makes the payment, it has to be ensured that the goods are received in India. But if somebody is sitting simply silent, not possible or not permissible. Okay. So how normally one has to make the payment? One is banker remittance, which normally we know. Other one is through LCs, that is documented credit, what we call, right? Other one is through the EFC account, that is exchange earners foreign currency account, which is maintained by the export earners, that is those who are doing exports outside India. If they earn foreign currency, they can keep in this account called EFC account. It is basically a foreign currency account. One can suppose they can open EFC dollar account, EFC pound account, EFC euro account. Okay. Based on that, from that EFC account, amount can be paid outside India, so that there is no foreign currency risk is involved. The money is lying there, and simply they can use. And generally, there are no time limits up to which EFC payment can be made. EFC can be paid up to the balance availability, and this is the current account basically. So normally there is nothing called credit on EFC account. Means no OD can be given for EFC. It should be a normal account. Okay. Or any other account, if the exporter is maintaining outside India, there is a possibility that if suppose there is a project exports where somebody is importing goods for performing a project outside India, right? In that case, maybe they can open the account outside India and also they can make the payment, or accounts that are being maintained in India, that is not a EFC or current account, whatever, we can make it out. And also for imports, we can make the payment to credit card or debit card as well. Because credit card or debit card is also considered to be equivalent to foreign currency inflation. Okay. Accordingly, all these modes are permissible, but any other mode is not permissible, such as making payment in cash. We have some INR, we want to make the payment, not possible. We have some foreign currency carrying, abroad, we can't make the payment outside here. That is considered to be money laundering. So anything paid in INR or, in cash of any currency is considered to be money laundering. Even though otherwise legally we obtain the foreign currency, we can't use it for making any imports. Okay. So normally, whenever anybody, an Indian importer want to make a remittance outside India, they have to use, earlier there is something called Form A1, and if the amount is more than $5,000, this Form A1 was supposed to be filed along with the payment request. But now, that is from 12 to 2015, this has been withdrawn, whereby after this date, even a simple letterhead will be sufficient to make the request for payment. But of course, the banks may have different formats. So typically, they are still following the format similar to Form A1. Okay. So there would be request, but along with the concept. Yeah. And other documents that are required is exchange control copy, because generally whenever the importer makes the submission for clearing the goods, we call it a bill of entry. The bill of entry, exchange control copy means it's a fourth copy normally. Okay. The fourth copy need to be submitted to the AD, and in case it is a postal imports, like courier import or postal import, we need the appraisal form received from the customs authority. And if suppose some goods are subject to any licensing, like actual user license conditions are there, then those import related licenses also need to be submitted. Otherwise, they are not permissible for imports. And other documents such as Form 15CA or 15CB, if it is required, that also need to be produced. So when 15CA may come into picture? In normal imports, when we can think like there could be requirement of Form 15CA or 15CB. Sorry. When it may come. Because normally, if you see rule that is on BB, imports are subject to, are listed in that 33 clauses, one of the 33 clauses. So normally imports are not subject to TDS. But if it is related party transaction, or if the seller happen to have PE in India, whereby there is any permanent establishment in India, there is a potential TDS liability in India. So that's why one has to check that when there could be TDS liability, accordingly the TDS need to be deducted. Of course, Form 15 CACV accordingly it will come into picture. Okay. As I was telling, there is something called trade credit we were discussing about. If suppose the import is going in excess of 6 months credit period. Okay. So one can import the goods beyond 6 months credit period if the goods are of non-capital nature, such as raw material, consumables, spares, packing material, where there is no capex involved, then the maximum credit period is 1 year. That is 1 year or the operation cycle, whichever is shorter. The lower of the operation cycle are 1 year. Okay. But if someone is importing capital goods, that is goods used for setting up any factory or for any expansion of the capacity, then the import can go up to with a credit period of 3 years. Okay. Either 1 year or 3 years, but there is a process to be done whereby the banker has to be intimated with respect to the transaction is subject to elongated credit period. We can't just like import and sit idle. Because these days the system is throwing a lot of alert, something called IDPMS, that is Import Data Processing and Monitoring System, which is implemented way back in 2016. Now it is matured enough to calculate or to see that how many imports are outstanding beyond a particular period. So if the imports are not paid within proper due dates, what will happen? They will be treated as the import defaulter. It means the system can throw alerts saying that there is something fishy. Then naturally there will be a love letter from the either RBI or AD Bank or from Enforcement Directorate saying that how come these transactions are outstanding. Please remember, whenever ED comes into picture, that is Enforcement Directorate comes into picture, all automatic routes as otherwise eligible under FEMA gets closed. It means everything we need to go for approval. So always we need to pray that ED should never come into picture.
Okay, can you repeat that? What approval you are referring to?
If whenever there is any kind of notice issued by ED for the purpose of adjudicating any non-compliance under FEMA, until that matter is closed, if there is any inspection or investigation is going on by the ED, then whatever automatic route the importer or the Indian party otherwise eligible to will become under the approval. They can't get FDA, they can't make ODA, they can't get any kind of advance receipts. Wherever a liberty has been given, all those liberties will become null and void. So that's why one has to be cautious that we need to maintain the properly in a clean and clear manner. Otherwise, if ED comes into picture, everything becomes subject to some approval. Whether it could be ED approval or it could be RBI approval or sometimes it could be AD Bank approval. Okay. So of late, what we are all suggesting is better to carry a periodical health check under FEMA just to see that what kind of non-compliance could have been accumulated. Thereby what will happen, we can reduce the baggage as we go forward. We'll give you a simple example. Non-submission of a bill of entry, these days invoking, the enforcement from ED. Like in one case we have seen, the levied penalty of maximum penalty that is given under FEMA is 300% of the amount involved. Okay. Of course, it was small amount, hardly it is some $7,000. On $7,000, the levied penalty of 300%. Imagine if it is $7 lakh, one has to pay 3%, 3 times. Okay. So as part of audit, though we have been doing audit in terms of checking each and every financial aspect, but we have been observing the implications under FEMA are largely ignored. Like suppose somebody imports the goods and immediately they make a setup. Like suppose for one export they make a setting up of import. We think like financial liability is knocked off. So liability is exhausted, asset is also relaxed. We feel happy. But the same thing normally wouldn't reflect in the bank records. So banker says you have to import make the payment for the goods which are imported. Also, you have to realize the exports that are otherwise showing outstanding. These are two independent non-compliances. Suppose say $1 lakh we have made imported goods, and equal $1 lakh we have exported to the same party, and we are setting it out in the books. Actually, as far as Rama is concerned, these are two independent non-compliance. These $2 lakh worth outstanding non-compliance are there. So while we are adjusting financials, we simply say that okay, same party, there is an actual import, there is an actual export, so we can set it down. No, there is a laid down procedure we have to follow. Otherwise, both in EDPMS and IDPMS, both records shows outstanding. One in terms of the import, other one in terms of the exports. Okay, so thereby what will happen? This will become a critical process where an importer genuinely otherwise permissible could not able to take it. Okay, and for any trade credit, the maximum amount per shipment is $50 million, which is sizable enough. It means we can go up to 3 years for credit capital goods, provided the value of import is not more than $50 million. Of course, there are certain category of oil field companies where it can go up to $150 million. Okay, and normally beyond the 3 or 1 year period, no rollover is permitted. It means it's a maximum ceiling. We can't bring it for 6 months again. We want to roll over again. We want to roll over. The cumulative rollover period, if it goes beyond 1 year, it is a violation. And the maximum interest that can be paid, as I have been mentioning, is 300 basis points over and above the LIBOR. I mean, LIBOR now it is called as alternative reference rate, because now we are moving from LIBOR to different benchmarking. So London interbank offer rate, that's what generally we have been calling to LIBOR. Okay, so over and above LIBOR, it can be up to 3%. Okay, of course, this 300% has been enhanced up from 8th December 2021. Earlier it was 250 points. Okay, and another thing we observe is partial payments. Like suppose we keep on making on account payments, and in books we keep adjusting, but the same thing doesn't reflect in the bank records. Thereby bank adjust in an arbitrary way or maybe with improper manner. Thereby maybe an old bill is showing outstanding, a latest bill might have been paid off. So while we make any import payment, we must be very cautious that what purpose code we are mentioning. The purpose code is very important. Because generally we have observed while making remittance, we select the purpose code where AD bank says this is the easiest way you can remit the money, rather than the purpose itself what should be. Okay, with this what will happen? Bank record shows something else, again the books are showing something else. Generally in audit or any kind of due diligence or MIS reporting, we don't do thorough reconciliation of these kind of things where with AD bank record versus the books. Therefore what will happen? Always it shows something different, and we end up getting the notices largely. Even in one of the client case we have seen one SCJ unit, initially they set up one banker AD code, but later part, though bank account is continued, their banking activity shifted to another bank. They forgot to change it in the SCJ online portal. Thereby, every export is recorded with the one bank where actually they don't have any banking transaction, but they have been realizing the money through some other bank. So AD record shows, like suppose this is ICICI Bank, another one is a Axis Bank, example. So ICICI Bank they show the as AD code, but Axis Bank they realize the money. There is no problem. As far as banker is concerned, sorry, the exporter is concerned, it shows very categorically that the payments are realized. But as far as the bank records are concerned, where we have filed shipping bill, the AD code, there it shows as the outstanding. Where at other AD bank, where the money is realized, it shows that it is advance received. Same way exports also we have seen, sorry, imports also. We indicate one particular AD code while we are importing the goods, but payment is made from some other account, because we many times as an importer
We really like wherever fund is there, make the payment. There is nothing wrong in it, but the only problem is bank record is unreconciled. With that, naturally, the ADs these days they are sending, they are raising complaint to the ED directly. The AD banks, they themselves, though they failed to perform certain activity, they are only making complaint to the ED, saying that these particular non-compliance are observed as per our record. In one case, the case I was referring to, it was almost 350 crore worth. Exports are shown as unrealized, and almost 250 crore was shown as the advance received without export. So net 600 crore is outstanding. Okay. Then obviously ED has come into picture. Unfortunately, the promoter, while he was in COVID scenario, we had to attend to the enforcement directorate. And it is a torture. If anybody wants to enjoy the life, one has to go to only 3 or 4 places. One is always ED office. When I say enjoyment means they will become sannyasi. That's all. They will not take any business. That is the kind of literal torture they do. We have seen the senior person who was just hardly a month before, he was suffering COVID in the first wave. He has not been given water, he has not been allowed to go out, he has not been given food. They say that only by torturing you will open up yourself. Naturally, they think like, the moment you realize that, this is not the life you want to, naturally, whatever mistakes one has done, they try to, accept. So the conviction is easier. Okay? Because again, ED, largely they come, most of the representatives, they come from the police department. So they know how to get the information. Okay? So that's why of late, one has to take care of this particular FEMA compliances, both in terms of the imports, exports, or any other regulation. Of course, there are 27 regulations. We don't know which regulation we are trying to, corner. So basically, one has to always clean the books, not only from the internal record, but from the bank records also. Okay. And of late, again, the bankers are also turning into funny stage, where their branches also, they are independently complained to the ED, not at central level. Each branch itself, they are giving complaint. Even in another transaction in one of the client case, we have seen for one import payment, they are given as a suspicious transaction report. To FIU, they filed the suspicious transaction report. It led into investigation both under the income tax and under FEMA. Okay. So the way the enforcement has started to be increasing. So it's not so easier like, document whatever we give, the banker will take it as is. Even if they may take it because they may not have familiarity, but the compliance team or compliance systems are throwing alerts, or, they are raising complaints. So we need to be very cautious as far as the cross-border transactions are concerned. One has to be very cautious. We need to reconcile the record. Okay. So, any clarifications with respect to this? Because these transactions, though we know that every day we are dealing, largely the compliance perspective, we are blindfolded. Okay. And whenever you want to do advance remittances, basically if it is for import of goods up to $200,000, of course, without any advance bank guarantee, one can make the remittance. When we say advance bank guarantee, it means the recipient has to give a bank guarantee for receiving this advance. Okay. And for services, the money should not be more than $500,000. If the amount is going beyond that, they need to take the advance bank guarantee. Otherwise, the AD bank should be satisfied with the bona fideness of the transaction and with the track record of the remitter to say that there is historically there are such similar advance payments made. Hence, there is no risk posed to the country, because we may think like the importer is losing the money, but the country is losing the foreign currency. So always FEMA talks not from the individual, corporate or individual level, but from the country level. So one has to be always looking at the national interest before the personal interest, right? And whenever there is a SBLC, that is standby letter of credit, where there is a import advance is counter secured by the SBLC, then there is no problem. But again, it should be issued by the Bank of International Repute. Okay. We have seen another area where, if suppose a company has directly received the shipment documents, such as BL or surrender BL or any other document, invoice, packing list, okay, or any other insurance document, it could be multiple documents. So if they are received directly by the company and if the goods are cleared, many times there could be violation. Because normally these documents are supposed to be received through the bank and goods are dispatched after making the payment. I mean, goods are cleared after receiving the payment only. But for certain category of importers, such as corporates, listed companies, or group entities, there is a relaxation given for document clearance directly by the importer itself. But still, one has to see the import evidence is given to the banker. Otherwise, advance is made, payment is made, but import is received or not, we don't know. Okay. Further, always the documents evidence in the import should be submitted to the AD bank. And for this also, we have seen compliance, non-compliance issues. And one important thing, under FEMA, whenever ED comes into picture, they are asking details since 3rd May 2000. If at all the company is incorporated, say anything before 3rd May 2000, that is the day when FEMA has been notified. So they are asking for last 21 years. Suppose if they receive notice today, they are not asking only for last 5 years, 6 years, 8 years, etc. They ask the details since 3rd May 2000. So one has to carry the data of last 21 years if at all the company is existing for this much time. Okay. But one may be wondering that which law mandates this. Of course, under other laws, there could be the maximum time is 10 years. Like if you take under income tax, it is 6 years. Okay. Or if you take under the Companies Act, it is 8 years. If you take under the PML, it is 10 years. Okay. But for FEMA, there is no time limit applicable. So that way, they can ask, and the importer or exporter has to give evidence of all the compliances till the time they have been in existence, or on or after 3rd May 2000, whichever is later, whichever is shorter. Okay. So we need to be very cautious. That's why the carry bag should not be there in a very high quantity. Like suppose today there is any bigger non-compliance been identified, the ED is going back for the entire history, each and every line, whether you have made so much advance or received, paid, import, export, FTA, ODA, a given guarantee, taken, the derivative contracts, everything they will dig into. So we must be cautious that we need to screen the record always on a continuous basis, so that the record always match with the books. That is the caution one has to take into the picture. Okay. Fine. So what is the evidence normally we should give? In case of physical imports, as we have been mentioning, all customs documents need to be submitted to the AD bank, and the exchange control copy, that is we call it as triplet or quadruplicate copy. So that need to be submitted to the AD bank, evidencing that so import has been made. Okay. And customer assessment, any certificate in case it is a postal imports. Please remember, postal imports of late are increasing. Again, due to the COVID scenario, a lot of imports are coming through the courier or postal system. So that also we need to check and validate that proper document has been given in proof of import. Typically, whenever we do audit, we don't look at this depth of data, but one has to check and validate the end-to-end journey of the import or export. Otherwise, even a small, document missing piece can create havoc in the present system. Because we have seen IDPMS data or outward remittance message, which we call the ORM. Now they are tightly being monitored. Same way, exports also, EDPMS and IRM, inward remittance message and export data processing. So these two records, I mean 4 sets, EDPMS, IDPMS, IRM and ORM. These 4 records we need to do proper check just to ensure that the books of the company versus records of the bank are in line. Else, we may have to face a lot of issue, especially after the digital data is, penetrating a lot. Okay. And for non-physical imports such as software purchase, online import, online download, or some document is received via email. Any of those kind of service being imported, there should be a certificate from either CEO of the company or statutory director of the company. That is considered to be evidence. And in case any bill of entry is misplaced, there is a potential possibility that bill of entry is misplaced. Then if the value is up to earlier $100,000, which is now increased to almost $1 million, there could be, we need to raise a complaint before the police, or we need to submit the FIR copy saying that so-and-so bill of entry has been misplaced. Okay, just because it is misplaced, we can't sit idle. Otherwise, that is also considered to be advance is paid and imports are not there. And for non-physical import, also we need to check about the GST compliances. Like, as you know, under service tax, or sorry, GST, there is something called reverse charge mechanism, right? So generally we tie to that. So this certificate, need to be submitted on a voluntary basis. Generally, people don't, submit this, and they end up paying as one of the advance being made without corresponding imports. Okay.
I have a question.
Yes, sir.
Imports, you mentioned about SECs also. So, SEC itself, if you're buying from another SEC,
yeah,
that's also technically is an import. So will it qualify as this import or?
It is ex-bond to ex-bond, means from one bonded warehouse, we are shifting to another bonded warehouse.
So what is happening is, we are importing from another SEC. That is also getting reflected in the bank as IDPMS. Is that a possibility?
Ideally, it should not.
Should not, but it's already happened. Now we are like, we put an army to reconcile, but the bank accounts are as bad as any other.
Yeah, even worse than any other.
Any other, yeah. They themselves don't know why it is happening.
Correct. Because while it is SEZ online reports are submitted, if we give by a mistake, it is as a DTA clearance. Because
what's the concept? We have realized after 4 years only that all imports we are doing from another SEC is considered as an IDPMS as a payment to be done. And not only that, between two SECs of the same company, if there is an inter-unit transfer,
okay,
it is getting reflected in the IDPMS as a payment not done because there's an import bill of return between the two entities.
Oh, this may be useful. Okay, we are not come across that situation, but I think then we need to make a request.
So we are saying it is it is not a no payment is to be done.
Obviously,
But it cannot be cleared in IDPMS without a payment. So it's stuck there. So
maybe this is a more of systemic issue, right?
it is, but the ED is watching.
Yeah, of course. Now, all channels are watching us in such a with the PS data.
Yeah, so
We,
I was just thinking if you had any experience on this.
no, we have not come across this particular situation. Ideally, we should do one thing, because generally whenever there is a wrong data fed into the customs duty data, because this IDPMS data is emerging from the customs data. Okay, so ideally we should make a request to the NSDL who is maintaining that NSDL online, SEZ online data,
Okay.
where NSDL is the data administrator. Okay, So we need to make a request to them that why these things are getting reflected into the customs, internally to the AD bank as towards the imports.
Where is that authority in NSC?
SEZ online is what you know, you can.
It's used by our own team only. It's not that we are only using the SEZ online import. The document is all uploaded by the in-house team only.
True. You're uploading the data, but that should not reflect as towards the import. While the data is shifted from SEZ online into the customs data, again customs data is merging into the RBI data.
So we can
Even first, yes, why this is being considered to be imports when it is export to export? Because from one point of warehouse we are shifting to another point warehouse.
Okay.
Where both SEZ units are covered by the bonding.
Yeah.
So ideally, is one such situation, and also because this is not considered to be a kind of typical import, because unless it is import from DTA or import from outside India, it will not be considered to be import. Okay, it's a considered to foreign territory always.
Yeah.
Okay, so that way it should not be reflected in imports. Okay, then maybe you can raise complaint. One is to the development commissioner, other one is to the, because our SEZ officers are directly reporting to development commissioner, also SEZ online, because AD bank cannot do anything in this. Please remember, AD bank says I have received the data, I have not generated data. I am not the originating person. So this has come through SEZ online into the customs portal. So, and in one of the case we are struggling hard to make a small change in customs. Say even after 1 year, I don't think the windows are open.
We also tried 1 year. So we just pay it up and close it.
But for the company to company, how you get it?
Whatever I have to get the name of. What I'm saying is that you're saying that we can speak SEZ, but they are also equally lost. Fully a gray area.
Yeah, of course. Yeah, now everybody learning. And nobody knows how the systems are functioning. Yeah. See, service company, if suppose they have any service imports, okay, there could be service imports, right? So we will not have any physical import, but still it is an import of services. For services, one advantage is we need only invoice backed with any PO or a contract. Okay, but the only problem is off late. In fact, there is a proposal recently been discussed among us, RPA, ED, and STPA, that largely either export of service or import of service, they want to create a separate channel to prove that there is actual import or actual export. Like suppose for all service export from the IT company, we are filing the software form. But for other than export of software, there is no specific form. So a lot of money is going out. But correspondingly, there is any import of service or not, only God knows. Okay. It could be. Yeah, that's what. That's why only of late there is a discussion going on along with STPA saying that all export of services, be it a software or non-software, let the STPA or some authority should monitor the very purpose of the transaction. Same way, imports also will be subject to their scrutiny. But as of now, there is no specific mechanism except the auditors or any other independent authority has to take care of. Like AD Bank, while they make remittance, they will check that what is the invoice, what is the PO, and all those stuff, right? And there is normally form 15CA or 15CP. Okay, but in spite of this, there is a potential, threat that the payment could not have been a genuine one. In spite of this, there would have been there was no service of any kind of import of service, but payment might have been made. So maybe invoice alone we can't rely. Of late, what is happening? Whether the so-called service is really relevant to the business or not. So one has to check even that also to the extent of the genuinity. Okay, because services are prone to any kind of misuse.
generally we don't go to the proprietary aspect.
True.
We are asking you to go to the proprietary.
But unfortunately, otherwise, see, what happens, sir? Of late, you look at any regulator, more than promoter, they are scrutinizing the professionals. They believe that we know everything and we are supporting the promoter for the mala fide activity. That's how every regulator is, treating. So we need to save our skin. So naturally, we need to have a lot of due diligence for certain, threshold based or frequency based or maybe country based. Okay, like we have seen one case in one of our client case. The seller is in a different territory, but their bank account is in another territory. So the payments are going to a different territory than the originating address. This they have shown it as the suspicious transaction. Okay, so the same party, the party is same. Like suppose somebody may be operating from UK, but they have a bank account in Hong Kong, example. Okay, so the Hong Kong bank account is owned by the same seller. There is a proof also. But why the goods are being, said to be exported from a different country, but payment is going to another country. Now that is also becoming question mark. And 80 banks operate, they are sending suspicious transaction reports. And this is triggering alarms to like FIU in the moment it goes, it may go to income tax, it may go to DRA, it may go to then ED, it may go to GST department. We don't know. So it will be a serial, kind of scrutiny from each regulator.
Say for instance, holding company is there, it is a subsidiary.
Yes, sir.
Subsidiary you have got 51%.
Yeah.
But the management is the other partner.
Yes.
So they are operating from a different country.
Yeah.
And they have got their own bank accounts there, but it's a consolidation happening.
Correct.
We have some. If I have as a for the holding company, I am your.
Yeah.
If you are transacting, I am not comfortable.
Yeah.
How do I go?
See, any transaction when we are not comfortable, we can disown the signing.
I'm not saying somebody said.
Holding company we cannot control. But at least Indian link, the Indian link we need to scrutinize thoroughly to the extent possible. Because of late what is happening, we are made as if we are the detective. We are doing obviously detection only, fraud detection audit or whatsoever we call it. At least large volume transactions, we should go into the genuineness of the transaction rather than a document alone. That is the depth we need to see. So, otherwise, what will happen? The regulators are asking why you are paid to detect this. When ED is calling, RBI is calling the auditors directly to explain the case. Otherwise, they are raising complaint directly to the disciplinary committee of ICA, saying that we failed our, to discharge our duty. Okay. In fact, unfortunately, yesterday, 3 days back, we have seen one case. One company secretary has been subjected to arrest because of the one Chinese companies. They floated multiple companies in India, and they have pocketed some 2.54 crores or so. Okay, it's a pure online duty. The company secretary unfortunately acted as the Indian resident director. One employee has been made as another director. And they have been arrested just on 25th of December. Earlier they have been arrested and released on bail. See, professional life now, I think it is turning out to be a different game. We can't only believe the promoter. We need to do little more due diligence. Okay, that guy hardly, for the sake of some sitting fee, he has lent his name, and now he ended up in jail. Okay. So that's why we can't take the things as we have been seeing earlier. Okay, maybe the money greed is running the promoters into different direction, but we need to be very cautious. Okay. Another area that is very interesting to see is about the this is what I was referring to, the IDPMS and ORM data, where all imports are now getting reflected by each line. Earlier it used to be a consolidated data, but now it is getting reflected by each line, and each remittance is also getting reflected as separate line. So it is line item wise we need to match. Maybe multiple outward remittances may be matched with the import, or multiple records of import can be matched with a single foreign. So many to many relation is possible. So one has to check the data with this particular record to check that imports there is no out of the boundary conditions are there. Okay, and of course this is been activated in the year 2016, whereas for exports it was made in 2014. Okay, and the data is getting captured here. One is through EDPMS, the EDA ports, that is exchange data interface, right? Automatic exchange is happening from the customs into the RBI record. If it is non-EDA, EDP ports or EDA ports, basically they have been uploaded through customs. Okay, so in any case, it is getting reflected by record in the AD bank data, and we need to check this data on a periodical basis just to ensure that data is in sync with the books. If there are small amount left over, could be like there is a discount or there is some bank charges involved. There could be a number of ways where each record could be left with something. Okay, if cumulatively the amount is very high, even for that also ED is inviting notices, issuing notices. So that's why we have to, apart from every other reconciliation we do, like we talk GST reconciliation, we talk say payment reconciliation, we talk foreign currency gain or loss calculation. Apart from that, we need to reconcile these two with these two records as well. Then only it may become a complete data. Okay.
In case of samples, when we get the process where there is no payment.
Yeah, samples is always paying, because the way the documents are being shown as if it is subject to some value, because for customs purpose duty anyway we have to pay. But if it is free of cost samples, while making the request itself for import, clearing, they should be categorically mentioned that no commercial value is attached. By mistake, if they create it as a normal import, it is becoming a helpless task. I don't think really there is any clear guide or path in this particular thing. We need to spin between the customs and RBI, because recently we have seen so many cases. RBI says if the customs says it is payable, you should pay. So first you get and rectify the customs data. Customs people, they say there is no possibility to rectify their data. Okay, it is catch-22 situation. So better while clearing, maybe the client must be aware that they need to take the appropriate advice of the CHA while they are filing the clearing documents. Here itself they must be very, very clear. And of course, largely the information will be disconnected between the clearing department versus the accounts. There could be always a gap. Okay, while we raise the PO, for many PO is required if at all. We will mention that no customs data is, no value is involved. But while clearing the goods, maybe it may go as a copy paste template. Okay, so that's why we must be very clear on these counts. For samples also, these days, like we have been clearing now 2013 data we are clearing now for one of the clients. So much samples they got for testing and study purpose. Okay, so but we have to be very cautious. Okay. Another leg, there is something called merchant trade. Like suppose without import and without export, we may do a trade. Okay. So if there is any import which is not coming into India and it is directly shipped to a third country, and we are making remittance from India and we are receiving remittance into India, both cases possible. Okay. So it's a cross-border trade without touching India. That's what we need to look at it. So whenever it is a merchant trade, where goods are not entered into India, or goods are not entered into any of the customs area, and they have been shipped directly from manufacturer or to any other trader to another customer. So we need to see that the goods should be permitted. First of all, under foreign trade policy, the goods must not be a restricted goods. And country is also not a restricted country. Like suppose we can't buy in Iran and sell it to China, example. Because Iran is subject to the sanctions by the USA. The moment it is a sanctioned country, we can't do trading with them. Maybe for import we can do it in India, but we can't do merchant trade. Okay? And maybe if they are subject to any other FATCA compliance, I mean for this FIU compliances, there also we cannot do certain transactions. And entire merchant trade transaction need to be done through only single AD bank. We can't do remittances from multiple AD banks because it requires to be consistently verified. Okay? And the entire transaction, that is first transaction to last transaction, it has to be done within 9 months of the initiation. Okay? And there should not be any outflow after 4 months of the first transaction. Means we can initially receive from customer, thereafter we can make the payment, but we can't make advance payment and then try to receive it from customer. So always first inward, then outward. But generally, outward could be sometime required, but there shouldn't be not more than 4 months gap for any outward remittances. And we need to prove and submit that both export and imports are completed by giving the bill of lading, because there is no bill of entry and there is no shipping bill. Because bill of entry comes into picture only when there is actual import, and shipping bill comes into picture only when there is actual export from India. So here what the proof we have is only bill of lading. Bill of lading taken by the seller as proof of shipment. Okay, all those documents we need to submit here to the AD bank. And outlined otherwise for this purpose also we are seeing a lot of non-compliances that are being raised before ED. Okay. And if suppose the outstandings are more than 5% of annual exports as such, then the seller may be cost sensitive. Means again they are subject to all approvals, maybe FDA, ODA, whatever, they will come under the approval route. Okay. So these are the critical things as far as the exports are concerned, imports are concerned. And import of services, as I already mentioned, there is a current account transaction. Yeah, sorry, sir. Yeah.
I'm importing for my consumption to produce finished goods.
Of course.
There is a problem in my production line.
Okay.
Then I sell it to another vendor saying that you do and give me.
That is job work.
The job.
Okay.
I don't know whether he has used it completely for PR.
Okay. Like you mean to say the outward quantity versus inward quantity, we are not able to reconcile. But general record has to be given. Like somebody takes our material, they need to render the account also. Ideally, generally our supervisors will be there if at all.
Correct. Say for instance, that particular item has got normal wastage of 70%. Due to I'm able to make something out of it.
Okay.
Acceptable wastage is 70%.
Okay.
If I'm able to make it at 30%, then 40% I will do it.
Okay. SION, that is standard input output norm, says it is up to 70% is the wastage, whereas the Indian party may be able to maintain at 30%. So 40% they are optimizing. Okay.
So do I have any challenge there?
So long there is proper accounting, shouldn't be an issue. But suppose if it is diverted, that's a different story. That's a different story. Okay. Yeah. Yeah. And yeah, one more thing I wanted to mention. I think this is one area we have seen. Suppose for import of technical services. Suppose we have seen like, recently for one client, they are developing one a portal for hosting the content, the OTT content. So a lot of development they need to do in that OTT content. So while they are making remittance towards import of services, the value has gone beyond $1 million. So here we need to see import of technical services. When we say technical services, it could be coding or it could be extending a system services like OTT platform and as a platform as a service or infrastructure as a service. We don't know. Okay. So then RBI approval is required if the amount is going beyond $1 million per project. If it is not an infrastructure service, if there is any technical services involved, the maximum amount that can be paid per project is $1 million. If it is an infrastructure service, it cannot go beyond $10 million per project. So depending upon whether it is infrastructure or non-infrastructure, again, there are boundary conditions that, up to what amount we can make the remittance. And for pre-incorporation expenses, this is another area we have seen a lot of non-compliances. Suppose a Hollywood subsidiary is incorporated by a foreign company. All incorporation expenditure, if they want to simply convert into pre-incorporation expenses, that's not possible. We need to check that whether it is meant for the pre-incorporation expense or not. And the maximum amount that can be reimbursed is either 5% of the investment brought into India or $1 lakh, whichever is higher. But only thing, it should be wholly owned subsidiary. It cannot be anything less than 100%. Okay. But if it's not a wholly owned company, wholly owned subsidiary, then we need to take the approval from Reserve Bank of India. Okay.
Sorry, we are importing $1 million worth of technical services. We need approval of Reserve Bank of India.
Yeah, it is $1 million per project.
Per project.
Per project. So what is project is depending upon the scope.
No, the project will be $50 million. So we can always have overall more than $1 million, 3 different vendors. So still we need an approval of RBI.
It says per project, basically.
Okay.
But if suppose you are splitting a bigger project into among 3 vendors,
yeah,
all put together we need to calculate this. It is not per remitter.
What's the funda? Doesn't make sense.
Risk update. Risk update. RBI want to check because it's a service, right? So it can go. So it is prone to misuse.
7 crores is what is $1 million?
True. But of course, this is what is the threshold they made out. This is there since 2005. So though there is a kind of the inflation, but this number has not been varying. Okay. So till now it is subject to RBI prior. Okay. Any break is there? Tea break or something?
No, if you want, you can give some. Up to you.
I mean, I don't know. Maybe people are comfortable to sit. I don't have issue. That's what. So please take the break so that we will continue with the export of goods.
Sure, sir.
అది రిజిస్ట్రేషన్ అప్పుడు వచ్చే నంబర్ అది ఓకే సైన్ వస్తుంది
यार పోయినట్టు అన్నాడు
ల్యాప్టాప్ తీసుకున్నా డెల్ ల్యాప్టాప్ నుంచి
పంపిద్దాం పంపించి
తొంభై పంపుదాం
రే వీడు చూడు
also. So here again, for export, there is a separate master direction because RBI of late has started compiling the related circulars or rules and regulations into this compilation of master data. So again, of course, this export of goods and service related master direction for the updated only up to 8th January. But the regulations are updated up to September 2021. So master direction is now standing independent of it. So the foreign exchange management export of goods and services regulations 2015, they're actually updated up to September 2015 as a separate document. September 2021. And the master direction is updated only up to 8th January 2021. So again, unfortunately, the master directions are supposed to be the updated one, but it is theoretical as of now. In many cases, we have seen they are not fairly updated. So we can't simply go and jump into the reliance that whatever there in master direction is what is we need to comply. That is always a challenge. Okay, and always because current account transactions are rules also applicable per year whenever we see certain transactions. So generally there is a question that whether the invoicing can be done in INR or in foreign currency. Because all exports, always this confusion comes through. Of course, the foreign trade policy has a fair amount of answer that invoicing can be done in any currency, be it INR or foreign currency. But if it is towards the export, basically the relation has to come with the underlying transaction of foreign currency. But invoicing can be done even in INR or in foreign currency. The only thing is who bears the foreign currency risk is what is the difference. Like suppose we bill in INR, the Indian party, naturally the foreign currency risk is shifted to the payer, the customer. But if it is in foreign currency, the Indian party bears the risk or reward of the foreign currency invoicing. Okay, and basically exports always need to be coming through banking channel. So we can't receive the money otherwise in kind or through payment of in cash. So we can't realize the money other than through AD bank. Like initially billing in one currency.
Now there is a problem, and then there is a lot of volatility. And that's why I was doing in USD. Now I started doing it.
Sure, we can do that. Like whatever we have done once, we can't change that to another currency. Like suppose in November 2021, we raised an invoice. We raised in foreign currency. Now we realize that foreign currency there is a lot of volatility. We can't go back and change that particular invoice into INR. But whatever we are exports we are doing, of course we can do in any currency. There is no problem. Invoice to invoice we can change. Customer to customer we can change. Country to country we can change. Okay, and even project to project also we can change. There is no parameter like what are the compatible parameters. We can change depending upon each case and scenario. If the same customer for same project, one invoice we can raise in foreign currency, another invoice in INR. Even that is also possible. Okay, and another thing is exports. We can realize in INR only for certain countries. Like suppose Iran. Like any exports we make it because they are sanctioned countries. Obviously, we can't realize the foreign currency from them, or we can't neither make the payment to them. So there is something called barter system. So as far as Iran is concerned, we are making export. We say we means Indians are making export, and also Indians are making the imports. So at the country level, there is a adjustment, arrangement is made because we can't exclude a country. So the sanctioned country as such, there is no permission for dealing in foreign currency. But imports and exports are permissible, and the payment is made as a set off at the country level.
Say for instance, I have made a invoice, and then all of a sudden in that country there is a restriction of outward payments.
Like you take the same Afghanistan kind of scenario, right? There is a lot of havoc now. Yeah,
So now it has crossed 180 days.
yeah. Like whenever we exceed that 9 months period of, realization or earlier 15 months realization, basically we need to make a request to the AD bank for giving extension. We can't sit and say that, AD bank will give, so I need not to make application. We need to make a specific application for extension of time. And they need to give it. Once they give, they will mark it in the extension data table of the EDPMS. Otherwise, it shows as the overdue receivable.
Now they are saying that we can't pay.
So like we need to prove that what kind of effort we make to realize.
We went up to the ambassador,
Okay,
but he also put in a word.
yeah.
Nothing happened.
See, if there is a written correspondence proving our efforts, and also we seek an extension with the AD bank, it shows that, bona fide activity is there. Okay, but if suppose we simply do some document for the sake of documentation, sorry, without real persistent efforts. And there is a case, in fact, in September 2021 itself, a penalty has been levied up to, I think, 150% of the unrealized exports. Okay, and it went into the appellate tribunal also. Tribunal said, the ED was paid enough because he has not levied 300%, he has levied only half of it. In half of it may be bigger amount, but still the right to levy is up to 300%. So these extensions should be properly documented.
There is a writing of paid out your persistent effort. It's not paid. You have to apply for write-off and there is a procedure.
Even if some insurance is there, ECGC insurance is there, we can invoke that.
Yes.
Generally, unfortunately, while we do export, we don't take insurance for the sake of cost. But we bitterly end up with the principal loss itself. Okay, so but once there is a proof that adequate efforts are made by the exporter and ultimately it ended up in litigation, maybe arbitration or maybe filing of case in the court or any other possible ways, we need to prove it. Oral instruction, oral documentation can never be approved. Maybe we can reach the ambassador, but there should be at least an email saying that ambassador has been contacted. But their reply will not come in writing. It will never come because we are Indians. Please remember.
No, when they were in a holiday in India, then we went and met them. They said, okay, we will do all those things.
Yeah, the happy moment, pleasing kind of scenario, they will make it, but they will never do any kind of written this thing. Okay, and in one of the case, we have seen the same issue. Of course, the ambassador has ultimately made to release some amount. Okay, but it is everything oral. But unfortunately, for regulator, we need to have documentary this. Okay, otherwise, the regulator may say that it is a money laundering transaction. So we need to have a lot of document as to prove that our genuineness. Okay. So the time period to realize the money is because of the COVID situation, the government, the RBI has given extension that any export made up to 31st July 2020, the realization period is maximum 15 months. Okay, but otherwise all exports need to be realized in 9 months. Okay, and if suppose goods are sold through warehouse established outside India, like suppose the seller itself, they established a warehouse outside India, from the time the goods are dispatched from India, within 15 months the sale has to be realized, maximum period. In case of warehouse, through via warehouse, and in case if it is a consignment sales, that is, we have a consignment agent outside India, then it is maximum 12 months from the day shipment happened from India. So normal 9 months, the exception period of COVID outbreak period was 15 months, goods through warehouse is 15 months, consignment sales is 12 months. Okay, earlier there used to be different classification, like Star Export House or STPA unit, SEZ unit, like that there used to be different timeline, but now everything is converged into 9 months. Okay, So if the exports are not realized within 9 months, it can be considered to be export defaulter based on the value that is outstanding. Okay. And another area we have seen a lot of non-compliance is receipt of advance against exports. Normally, the exports has to be completed within 12 months of receipt of any advance, unless it is a elongated contract. Like some services, it can turn out to be that a 10 years long advance contract has come into picture. Okay, in that case, maybe the customer is asking to ship the goods over the period of 10 years, and the payment is made with the concept of setting up this amount over the period of 10 years or maybe 5 years, but anything above 1 year. In that case, even before receiving money, we need to seek RBI prior approval to have the credit. But of course, they are given what are the guidelines for longer period. So basically, it should be like KYC compliant overseas buyer, and PMLA compliance always is required. And advance should be only for execution of contract. Means we can't use it for a different purpose. Like we can't get advance and use it for a different project. Ideally, it's like a capex advance they give normally, just to support the establishment of the required manufacturing facilities. Okay, and any progress payments, like suppose there could be 10% of advance can be set up against the advance, balance 90% may come as part of the regular sale. So they are all should be coming from buyer. It means no third party payment. And if at all advance has any interest liability, then again there is a cap of maximum 1% over the LIBOR rate. Okay, and refund should be always with approval of RBI. So we need to, when we select the purpose code, we should have very much clarity that is it a regular advance or elongated advance. So otherwise, again, change of purpose code is not going to be that much easier. Okay, and if suppose the advance are lying long enough, it can be considered as the loan, external commercial borrowing, and RBI is going to neutralize the notional interest. Like we have seen in one case, when the advance has been received and ultimately it is converted into the contract after 5 years, they charge interest of almost 36%, that is 12% per year they have taken beyond a particular calculation, and they charge a penalty of 36% almost. Of course, RBI have their own mechanism. They say it is neutralizing. Okay, any benefit that is taken. And suppose there is any outstanding by bill out of export, if there is any outstanding by each bill, the maximum outstanding can be not more than 10%. Like suppose $1 lakh worth of goods are exported. Maybe if at all we want to go beyond the concept of this what you call elongated payment, that is beyond 9 months or 12 months, 15 months, whatever the case may be, it can go up to maximum 10% of the preceding financial year realization, actual realization. Okay. Otherwise, it may be considered to be export defaulter. If it is considered to be 10% as the normal threshold. Okay. And any extension, we can go to AD Bank to seek extension, but generally they will give up at a time only up to 6 months. Anything above 6 months, we need to make a recurring application, and it can go beyond up to maximum 3 years. It means they can give almost up to 4 extensions. Together it is not more than 3 years. Okay, and they should always give the reason why there is a extension or self write-off is involved. Otherwise, in this may be subject to enforcement by the ED. They may say that you must have realized this money in other way around.
Up to 10% self write-off.
Up to 5% self write-off is permitted, but beyond 5, but up to 10, AD Bank can give extension. Anything above 10%, RBI only can give the extension or write-off, whatever the case may be. Okay. But even if we do self write-off, still we need to give the document to the ED bank. We can't simply write off in the books and sit idle.
5% of what? The realization.
5% of the last year realization,
Realization.
actual realization, not the same.
Then you have to do the reconciliation. OB.
Yeah, opening balance and realization, current year sale.
Last year receivable realized, current year receivable realized.
Yes,
That reconciliation.
yes, we have to do, and there should be a certificate given by CA evidencing the, by the way, this is by calendar year. Basically, these relations we go by calendar year. Yeah. So, and suppose this year, I mean 2021, we want to do the any write-off. 2020 valuation we have to do. Realization value.
So what was the opening receivables at that point of
Jan 20, additional sale and realization and any write-off therein, together like that, we have to bring it. And if there is any kind of customs benefit are taken, like any refund of duties or any extra advantage we have taken under various schemes, that we need to surrender, that we need to pay off. Okay. And basically, of course, we, yeah, sorry, yeah. AD can give extension, I mean, write-off only if the amount is not more than $1 million or 10% of the average export realized during the preceding 3 years, whichever is higher. Means, suppose if the amount is still beyond, they have to go to RBI. Though it is 10%, if the 10% is cumulatively going beyond, you know, that 10% of the preceding 3 years realized. Like sometime what will happen, suppose 3-4 years back, there is an export business. Presently, there is no business. Like only domestic business is there. Then there are no export relations. Right. In that case, AD cannot give that. Maybe AD can recommend for, you know, write-off. Ultimately, RBI has to. An interesting case is, suppose there is any such extension and there is any investigation before ED. Even ED may say that, okay, you go for RBI write-off, then you come back and take the compounding RBI here. That is also possible. Okay. Only thing is, so long it is not subject to any money laundering, RBI can condone or they can permit for write-off. Okay. So nowadays, even we are seeing cases being referred by DRI to ED, income tax to ED. Okay. Or sometime maybe SEZ authority to ED. We don't know. Like these days, it is many to many relations there. The information can come from any place. Okay. And sometimes part balances could be there, like, you know, there is a bank balance and bank charges, or there could be, you know, foreign currency translation risk, or could be some trade discounts are given or cash discounts are given. In that case also, we have to go to the AD channel to get any kind of write-off or, you know, the discounts to be noted. In all these cases, please remember, if the cumulative value is exceeding beyond a certain threshold, systems are generating alerts. Of course, AD banks are also sending a lot of notices to clear all this stuff. But if it is not done, after some time, it will be shifted to the ED. Like now, ED has become as good as the regular investigating agency. Like last time when we went there, for one NBFC matter, almost 35 NBFCs have been called. That day it was like, you know, a chaotic situation. Now, ED is becoming, you know, under PMLA, there are almost 125 sections are there. So it could be any case being referred to ED. And unfortunately, the same ED office is also responsible for the PMLA, PEMA related non-compliance also. Okay. And this is becoming very critical area of practice as well, right?
Sometimes even we got the money because of the procedural issue in the banks.
Yeah.
They are not clearing on the EDPMS or inspect. Yeah. How do we can always say that money has come, there is a procedural thing in case there is any. Can we move like that?
No, ED says only one thing. I rely on this data. If there is anything you want to get change of this data, go to the concerned person, implement the change and come back with the revised data. I don't want to interpret this data whether it is true or fair or any other thing. The only thing is go back to the concerned person, get it rectified. You make the efforts. Okay, if you require, I'll give time. But I don't want to deviate from this particular data. That's how their attitude is there. Okay. So be whatever the reason, like of course they are sometimes giving 1 month, 3 months, 6 months, even 12 months also we have taken in one case. Of course, it's only without giving further summons. They normally give summons, wait for the attendance. If the person do not turn up, then it will go into the money laundering allegation. Generally, they first target it as a FEMA non-compliance only. If FEMA non-compliance is not being proved, then it may turn out to be money laundering allegation. Okay. So if it is money laundering, then it will go to a different case, including arrest power, attaching the bank accounts. Every power is there under PMLA. But under FEMA, fortunately, they don't have that kind of draconian powers. Okay. And we have seen, attachment of cases and even arresting promoters then and there. When they call for the promoter only for discussion, they arrest it and put behind the bars, and maybe then they are punished before the judge and all those things. But of late, it is becoming very stringent. That's what we need to realize. Okay. So unlike before, where ED used to give good amount of time, we are seeing cases are being addressed in 3 to 4 weeks only. They want to close the matter in 3 to 4 weeks. That's it. They don't want to give too many extensions also. So that's kind of aggressiveness is there. Okay. And netting off. This is one area, netting off and setting off. These are the two areas where generally, we see a lot of adjustments in the books of the company. Like if in case of SEZ unit, where they do a bilateral netting, it means a person who has received goods is also supplying some other goods. So it's a bilateral. We bought something and sold some things to the same party. So it could be like we want to set up the payment and receivables with the same party, and it is called netting off. Only thing is this netting off concept is applicable only for SEZ units. See, services until April 2021 was not permitted. In fact, earlier only goods to goods was permitted. Okay. Now they given in such a situation that goods to goods is permitted, service to service is permitted, goods to service is not permitted. Okay. The only logic is what can be proved is what goods to goods. Service to service, both are out of the EDPMS concepts. Okay. So any netting off, setting off, or counter adjustment, so long it is service to service okay, or goods to goods is okay. Not even one leg should be service. Okay.
What is the procedure when you set off the EDPMS for service? What do we go for?
You get EDPMS in the service invoice will not be there unless it is R&D designs and drawings.
Yeah.
Okay.
Design.
If it is designs and drawings, it will obviously reflect in either IDPMS or EDPMS depending upon which leg we are talking about. Okay. Though it is service, but it is part of the scrutiny of the customs. Okay. The moment it is part of this thing, the counter transaction, it should be either goods or service. Like it can be two customs comparable document, or there should not be any document in the customs. But one in customs, one in non-customs is not permissible.
Say if I have EDPMS for service,
and
I don't have IDPMS for
service,
then
we cannot do netting off. No adjustment is permissible. Okay. So because they need to map the record by record. So one non-existing record, they can't map with the existing record, right? So that way they cannot. Okay. And warehouse, of course, we can do, when the exporter can set up the warehouse. And generally, warehouse can be set up with the proper approval because it amounts to opening a branch office outside here. So there should be RBI approval, and this is subject to renewal from time to time. So whenever we want to do export, this is another area we have seen a lot of non-compliances. if we receive the amount, we don't submit the proof of export. Okay, but you know, a funny thing is, within 21 days of export, we are supposed to submit this document. But banker says, when you receive the money, you please submit the document. Banker is comfortable. He doesn't want to keep the document with him. He doesn't want to be custodian. So what they do, they simply say, okay, whenever you receive the money, along with the proof of export, I will knock it off. But law says, within 21 days of export, we need to submit the proof of export to the AD bank. Even for this also, we have seen penalties on levy. ED asks for the data. That within how many days you submitted the proof of export to the AD bank. And we don't have proof. Because simply what we have is ultimate submission when we receive the money. Suppose if it is after 9 months, or say after 6 months, but 21 days we crossed. For this also there is a separate penalty. Okay.
What happens for service?
Service export, if it is software exports, where it is covered under the Softex, same thing is available. 21 days.
There is a possibility of penalty.
Happily, if they are having penalty left and right. Okay.
But as you said rightly, practical issue, banks are not accepting documents. We get money.
So that's where the best thing is, you prove it through a document that we submitted and they rejected it. At least that way it can save our skin. Mails, you see, of late banks are also started their own back office in electronic form. These days, like suppose we have seen like Bank of America. Okay, they are asking to submit only through electronic form, no physical document. So if the banks are also smart enough, we can submit through that. Otherwise, physical document we need to submit. Else it is tantamount to non-compliance.
Banks are asking physical documents.
Yeah. Yeah. Of course, we have all combinations, all permissible combinations. Like one PSU bank may have one system, another PSU bank another system, private sector bank another system, MNC bank another system. But we need to live with it. There is no other way, other go. Okay. Yeah, I think, yeah. So basically, this is what I think we have been discussing. So suppose someone want to send the concept of samples or for testing, where as part of testing the equipment got destructed. So whenever we want to file something called GR waiver or EDF waiver, okay, basically what we have to see is what is the value on a whole, how much amount we are doing exports. So the EDF waiver can happen up to 2% of average annual export during the preceding 3 licensing years, or 1 crore rupees, whichever is less. Means the sampling can happen up to maximum 1 crore rupee. But for pharma companies, they are given 2% of average annual without ceiling of 1 crore. For pharma companies, 2% of average annual 3 years earnings. But for non-pharma companies, 1 crore or 2%, whichever is lower. It's basically annual earnings. Exports means here they take it only earnings, not the exports. Because there could be unrealized exports. So always they take the exports actually realized. Yeah. Okay. But in case sometime we may send something as gift, 5 lakhs is the maximum value. Of course, if it is personally carried, it's a different story. But if it is considered to be via courier and all these things, we can send the goods up to maximum 5 lakhs. This is another non-compliance we have seen. In case of companies which are into software exports, if it is more than 1 month contract is there, we need to do every 30 days invoicing mandatorily. Means we can't delay the contract if it is a long-term contract. But if it is milestone-based invoicing, like suppose we need to reach to XYZ milestones, then only on reaching the milestone we can do invoicing. But for long-term contracts, every month they should be invoiced. From that month again 9 months is counted for realization. Okay. And we have seen one interesting case like export of video content through FTP. Is it export of software or export of service? Like suppose we are seeing any OTT content. We have shot it as a video film in India, and the film is uploaded through FTP. Is it export of service or export of software? But unfortunately, of late, there is an interpretation that export of video content is part of the software. In fact, we have received notices in 2 occasions that any such upload should have been reflected through softtext. And incidentally, that has to be complied through STP scheme. This is a new dimension we are seeing in this particular area, because the definition of service and software is defined under the export of goods and services, but service is not fairly defined. Service, again, we need to do interpretation. Okay, and the way it is defined under service for this particular purpose is a bit of vague. And unfortunately, the client was doing almost every year 20-25 crore. For last, I think, 12 years, they have been in business. So 250 crore, they are now undergoing the allegation of non-filing the softtext form. And please remember, because there is no specific benefit under STPS scheme, can we say that a softtext form is not applicable? Because there is no STPS scheme under the income tax law. Can we say, hence, no softtext form need to be filed? That's so generally, lot of units are interpreting. They are not submitting softtext form because there is no specific benefit under STPS scheme. But please remember, for all software companies, filing of softtext is mandatory, irrespective whether they have tax benefit or not. Maybe they can register as a non-STP unit if at all they don't want to be bound under the STPS scheme. Okay, but still, softtext filing is mandatory.
That we should furnish within 3 weeks.
Within 21 days, yeah. And realization, of course, 9 months from the softtext approval. Okay. And suppose there could be some other exports like lease or hire basis. This is another area we have seen where an export is made on a hire basis. It means we don't sell the goods, we give it on a hire basis. So there will be a higher rental coming on every monthly or quarterly or annual basis. For this, we need to take the prior approval. We call it EDF waiver. We need to take EDF waiver so that the money need not to come within 9 months. Otherwise, the goods, once it is shipped, the maximum period is 9 months. This is another area we have seen a lot of non-compliances. And whenever there is a project export or service export, it means we don't sell the goods, we sell the goods and services together. Like suppose establishing a power plant outside India. Okay. So there we supply the material, we also supply the manpower, we undertake the entire EPC contract. So that's a project export. Service export, again, a simple contract without any equipment involved. That is service export. So for that also there is separate called PEM, project export manual. Under project export manual, these particular contracts need to be approved. Okay. So maybe another area, this is one. I think largely what happened whenever a company want to open a branch outside India, what is the amount that is permissible for remittance? The remittance can be done for initial setup up to 25% of net worth. We can remit the money without any approval. If the net worth is negative, anyway we need to take approval. Okay, or 15% of average annual sales during the last 2 years. That is export sales. I mean, annual sales means export sales, whichever is higher. For recurring expenditure, 10% of the last 2 years export revenue, we can send it. Okay. I think, yeah. So what if there is a non-compliance? Whenever we see non-compliance, any typical promoter, what they do is they don't want to respond on anything. They will simply sit idle. But please remember, voluntarily going for administrative rectification and then compounding is always advisable. But only one catch-22 situation is who will well the cat. Promoter will not normally come into picture. Auditor doesn't want to, what do you call it, give any negative remark. So who has to well the cat? That's the question. Okay. And it is very painful to convince the promoter to go for the compounding, but compounding is always the best remedy for any non-compliance under amount. First, we need to do administrative rectification, then go for the compounding. The only catch is once the same one item, one particular regulation is compounded, we can't go for compounding of the same regulation in next 3 years. So there is a cooling period of 3 years. So any non-compliance happened after 3 years of the previous compounding are subject to adjudication, but not for compounding. So we should be very cautious. Once it is compounded, it's like we become a good boy. We should not do the same mistakes by hook or crook. Okay. So maybe still, if any clarification is required, I can take it. Otherwise, largely my presentation on the export and import is fairly covered. Capital transaction is like FDI ODI. Like ECB, of course, there is specified process we need to follow, like form ECB we need to submit for obtaining LR and FR. And periodically every month we need to submit form ECB2 within 7 working days of completion of month. Those things need to be done. Yeah. But at least today's session we talked of covering only up this. Thank you, sir.
Thank you, Murali sir, for your patience, wonderful, practical oriented presentation. I request people to give a big round of applause, please. Sorry, sir, to 31 December, busy and no extension of time, members' presence is somewhat lesser what we expected.
But
you have to
this
excuse
has
us.
happened 2 parties, sir.
Sir, once again, thank you on behalf of other branches accepting our request. I request to CA Neti Mallikarjuna Garu to present a memento to today's speaker, please. Thank you, Mallikarjuna sir. Friends, this is the time to give vote of thanks on behalf of SIRC for this 2 days program. On behalf of Hyderabad branch, Warangal and Karnataka branches, I sincerely thank you all of you for presenting and coming towards this meeting, even though your busy schedules. I thank SIRC Chairman Jalapati Garu, Hyderabad branch committee members, Warangal branch and Karnataka branch members for giving this opportunity to Hyderabad. We sincerely thank all the students also who accompanied us for these 2 days. With this, we are signing off for this program. And once again, I thank you to the taxi people also and the caterers also for arranging nice food. Thank you once again. I should not forget majorly the staff of Hyderabad branch who are the, what do you say, back end to completely virtually and to present all this live mode. The photographers, Ramu and team. Thank you also. Thank you once again to everyone. With this, we are winding up this.